Right, good morning to our wonderful audience and welcome to the BCI Offshore Investment Managers webinar, our first session for 2026. And I know it might be late in the year already, but compliments of a season and all the best. What could we expect, or should we wish for? Stable markets and politicians with rational thinking. All right, but let's see how things work out. This is the first day of a 3-day series extending over the next 2 Wednesdays as well. On screen now, we'll pop up the agenda for the day. And as you can see, Tanya and the BCI team again made for a super lineup of exceptional global managers with great insight. As usual, time allowing, we will cover questions received in that Q&A bubble as far as possible after each speaker, or we can always circulate it to the presenters and get some answers if we can't cover it. The sessions will be recorded and you'll receive a link in a day or two with all presentations and the recording of this session. So what changed from January 2025 to January 2026? Inflation looks more or less the same. If you look at market valuations, all global markets, just from a PE point of view, it almost looks more or less the same as well, where it started off last year and where it is now. But obviously market performance was up there and clients were spoiled during 2025. What we could call out is US fiscal policy with an uptick on federal tax refunds planned for consumers of approximately 150 billion US dollars in 2026, and Trump reform pushing for a 5% GDP growth. But time will tell and see if they can get to that. Geopolitical tensions remain high and visibly higher, I think, than 2025. With the US claiming control of Venezuelan oil and making a run on Greenland, which could possibly destroy the NATO alliance as we know it. And as usual, he is threatening to retaliate with tariffs on all who resist. Europe is kicking back, adjusting their own security, and especially that in the Arctics for obvious reasons. Do we continue to look towards the US companies for super performance in 2026, or do we need to pay more attention to other regions with good valuations such as Europe, the UK, Japan also ran hard, but also attractive still, and emerging markets that's benefiting from a dollar that is under pressure? And on the last point, how does a strong rand or dollar losing steam impact on an SA investor perspective? Will the Davos theme, a spirit of dialogue, prevail in a fracturing world? Europe and emerging markets are uniting and resisting the US in a fight for independence, respectively. So what can investors expect? Not that we have a crystal ball, but what we're going to do today with all these top managers is unpack the hard realities and facts and where all those opportunities are and remain. With that, it's my great pleasure to welcome our first presenter for the day, all the way from Luxembourg, Andrew Marks, Managing Director at Artisan Partners. Good morning, Andrew. How are you doing?
Good morning. Love it to be with you all today. Thank you for giving us the invitation to join you.
First time that you're joining our webinars, Andrew. You're normally based in London, but I believe you are traveling in Luxembourg. Beautiful hotel room background there. So again, thank you so much for making the time and coming on this session. And we're really looking forward to sharing your views, a little bit more about Artisan Partners, how you see the world and how it comes together in your global value strategy. Thank you so much.
Perfect. Thank you very much, and good morning to you all. As I said, it's a great pleasure to be here with you today. Just a moment of context on who we are and who I represent. Artisan is a multi-boutique. We run approximately 180 billion US dollars across 11 different autonomous investment boutiques, each with their own analysts, their own portfolio managers, and their own distinct investment philosophies and processes. But today, I'm really just going to be talking from the perspective of the global value team and their specific lens upon the world. So if you wouldn't mind passing forward on the slides just to show up the team. Actually, on the investment philosophy, let's go forward a couple more. One more. That's it. Great. Perfect. So here is a short view of the beautiful individuals that are involved in the leadership of this particular boutique. I was asked today to come on and maybe talk about some of the sort of big trends, big secular and indeed cyclical trends that might be affecting the economy and the markets. So I've decided to pick maybe just four of them to touch on briefly, given the short time we have today. And then I'll talk to you a little bit about our strategy and indeed what we're doing to try to tackle this and the ways in which our approach we believe is quite adept for this particular market environment. So without any further hesitation, let's dig straight in. The obvious theme that I think has been dominating a lot of markets in recent times has been artificial intelligence. I think from our perspective, there is no doubt that this is, transformative as a quote unquote sort of another information technology revolution, akin to sort of what we saw in the 90s with the internet and the explosion there. But I think, in a similar way, we think that it's actually going to take some years for this fully to play out and for the impact, various impacts that have been muted, whether it's mass redundancies, whether it's significant upticks in efficiencies and indeed profitability for corporations, to fully play out across the broader economy. And so this is not a case of everything happening all at once. There are, however, should we say, an awful lot of companies that are talking about it. But I think it's very important to try and pierce through the rhetoric from corporate management teams who on every single earnings call at this point seem to be referencing what they're doing in AI to almost protect themselves against any allegations of being slow to adapt to the new world order. In reality, the number of companies that are truly being impacted or truly benefiting from this is actually quite small. So picking on maybe just sort of four examples from our portfolio, just to give you a sense here of some of the ways in which we're approaching this particular space. I'm going to touch on maybe just four different names and give you a little view of how we view them. So the first of them is Samsung, which has seen, from a valuation standpoint, a massive rebound in operating profits, given their participation in the AI space over the course of 2025. Profits expecting to double, which is an extraordinary explosion in performance for a company by really any measure. The background here to Samsung is quite interesting. It actually dropped the ball and actually failed in 2024 to really, deliver on the high bandwidth memory that was required, the HBM, and was required to be used in typically the training of AI models and also in a lot of the data centers that has been, really at the center of all this hype around CapEx and spending. So they really missed the boat in terms of the early wind and explosion of AI performance. But in 2025, they solved their tech and their manufacturing issues, and are now really fully participating in that. And they were up by around about 125% during the calendar year of 2025. And we think that that's an extraordinary outcome for a stock that we were a big holder on, and indeed it's been our largest holding in the portfolio for some time. From a financial strength standpoint, Samsung, like a lot of Korean and indeed Japanese companies, tends to be run extremely conservatively, and is, in our opinion, seriously overly capitalized. I think they have about 10% of their market cap, which is approximately $650 billion, held in cash currently. So that's how conservative they are, which is good from a defensive standpoint, but not particularly good in terms of shareholder orientation. So I'd say that's probably the weakest of the areas and dimensions that we really favor. So that's an example on Samsung. On Alphabet, Google, that is the second name that we've really spent time on from an AI standpoint, trading around about 28, 29 times earnings today. So, I'd say closer to fair value. But they are, as you know, virtually a global duopoly with Meta, as it relates to digital advertising. But they've also got world-leading businesses across multiple other areas, whether that's search, whether that's the cloud business, YouTube, which is arguably one of the most valuable digital media platforms globally today. And within AI, they obviously have their own large language model in Gemini. And we often look at Google and we look at Alphabet. Sometimes people talk about OpenAI as an obvious sort of, should we say, protagonist within this AI hyperbole that we hear being thrown around. And I would just make the comment that we'd far rather have an organization such as Alphabet that is able to self-fund its development in AI, as opposed to OpenAI that bluntly needs to go out to market every time it needs to invest and develop its ChatGPT functionality. I think it's coming from a position of extreme strength in the case of Alphabet. And indeed, as many have, I think, commented in recent times, their latest version of Gemini arguably is proving to be a competitive beat against ChatGPT on many different levels. In terms of financial strength, they've got about 140 billion in net cash. So that's Alphabet. A third one would be Meta. Again, trading around about 20 times earnings. They're probably worth about 24, 25 times earnings. We still think it's got value in it. Again, world-leading social media platform. They have 3.5 billion daily users on their platforms with Meta, which is an extraordinary statistic. And clearly AI is making this a better business and making the platforms bluntly more addictive for their users. Time spent on Meta platforms grew double digits just in Q4 of 2025. And that is bluntly through AI, refining the algorithm, refining, the way in which content is put forward, and the value proposition to advertisers is therefore increasing in value as a direct result. So it is really helping. AI is really helping in machine learning here. Financial strength, they've got 40 billion in net cash. Again, we like that as a play. And then finally would be Lam Research, would be the fourth play for us on AI. Again, we think it's quite expensive today. We've actually been trimming that one. Share price is up nearly 30% just in Q4. They've got about 2.3 billion in net cash. We think the management is excellent. They've done a phenomenal job of managing what is frankly quite a cyclical business. Lam Research is essentially a wafer manufacturing equipment business. So they supply the Samsungs and the TSMCs of the world. Last year, if you think about it, total spending on wafer fabrication equipment was around about $105 billion in 2025. And they're one of the world's leading players in that space. So I'll stop there on AI, but wanted to at least tackle that up front because I think it's an area that a lot of people are talking about, and there is opportunity to benefit from that. But we would urge extreme caution and extreme selectivity. But there are maybe four ideas that we've been playing in that space. The second area I would touch on is maybe tariffs as another area from a sort of an environmental standpoint, from a sort of what have we seen in the markets, what have we seen in the economies. I think it's fair to say we overstated, or indeed were more fearful of the introduction of tariffs with the second Trump administration when he rolled out that infamous board back in April last year. And we felt that this could be, incredibly detrimental to corporate profitability and indeed to earnings. And indeed, what it signaled to the world economy was something that we were very nervous about. And it's fair to say, a year on, we have been, pleasantly surprised. I hesitate from being too positive based on what's happened in the last week, but I think we've been pleasantly relieved and surprised as to how little impact those tariffs have actually had. The US economy continues to grow and generate good GDP growth. And indeed, US corporations have proven to have fairly resilient earnings over the course of the last year, which we think has been, a positive surprise relative to what we thought might happen based on the rollout of the tariffs. But also Europe has managed to, I suppose, adapt and indeed, tolerate the tariffs and take them in their stride, to a large extent, which has been also incredibly encouraging. We don't see the GDP in Europe growth that we'd like. And indeed, that's an area of concern, albeit there are opportunities for cyclical recovery in Europe that I can talk to in a second. But nonetheless, I think on the tariff point, we've been, happy to be proved wrong and happy that the outcome has been, less dramatic than perhaps we feared back in April last year. So that would be maybe the comment I would make on tariffs. I mean, if nothing else, they've created short-term dislocations that has favored strong companies, which tend to be the companies that we like, with strong balance sheets that can take advantage when there are dislocations against peers in their market segments, but also created entry points for canny investors that have a sufficiently long investment time horizon. So that would be a comment on tariffs. The third comment I'd make is on US and China and a sort of pseudo Cold War. I would say that is real. And I would also say that is impacting some of how we think. Certainly, Alibaba was a name in our portfolio that I think most of the world agreed was highly undervalued for a long period of time, and we held it for a long period of time, and then we had a nice pop. And we chose to sell out of that company, not that we felt that it reached full valuation by any means, but we actually chose to sell out because it became clear to us that Alibaba was, very rapidly becoming a Chinese AI champion, as favored by the Chinese state. And given that AI is probably the most, polemic of issues at the moment, as part of that pseudo Cold War between the US and China, we actually took the decision to exit after we'd had a revaluation of the multiple somewhat on Alibaba, just because, at this, fragile point in geopolitical relationships between those two superpowers, we really felt it was too much risk on the table for what might happen. And there are a lot of things that might happen in terms of economic sanctions that could get extended, and indeed ownership then could get locked in, and we don't want to find ourselves in that type of situation with our client assets. So that's maybe a comment on that topic. And then finally on valuations, and it was referenced in the opening commentary here. I think from our side, when we look at the valuations across our portfolio right now, we've actually got in aggregate, if we add up and take the average of all of our discounts to what we perceive to be the intrinsic value of the names held in our portfolio today, roughly 37 names, in a concentrated portfolio globally, we're around about 25% discount to intrinsic value. That's not bad at all. In fact, it's pretty good in terms of prospective, future return outcomes that we would anticipate. It's not a golden rule, but nonetheless, if our discounts are, north of 20% to what we perceive to be intrinsic value, that's actually pretty powerful and pretty effective for us. So those are maybe four different areas of the economy, of the markets that have been in the headlines over the last year that I felt would be worth addressing up front. Shifting to maybe some thoughts on how to approach this and how to navigate this somewhat volatile and turbulent times, at least as it relates to the aforementioned rational or perhaps not so rational politicians that are controlling things at the moment. I think when we reflect on this and we think about how clients, how investors, savers should try to approach this market environment, we really believe that there are some basic rules that you should really implement. And one of those is to really implement a focus on active strategies and indeed on flexible strategies. And what I mean by that is you need to have sufficient flexibility in your investment guidelines to be able to be nimble, to be able to go to zero in multiple industries, to be able to massively reduce or indeed increase your weighting in geographies, responding to the opportunities of the companies in the marketplace, and indeed responding to the risks that might be affecting those companies that might be more geopolitical in nature or macro in nature. There has never been, in our opinion, as good a time as now to be nimble, to be benchmark agnostic, to not be forced to have exposures everywhere. Now is a time to be incredibly vigilant about these elevated risks we see around the world. And in order to be able to navigate those risks effectively, we think you need to be operating with funds that are, quote unquote, less constrained to represent all of the marketplace in a sort of passive capacity, or indeed just from a low tracking error capacity. We think that is pretty essential. So the ability to deviate meaningfully from benchmark and peers through minimal constraints and guidelines, we think is critical. In addition to that, I would mention that, we're looking at a wide funnel, and so not traditional value. You need to have a stable, experienced team, and bluntly, you need to be looking for strong balance sheet, financial conditions. You need to be looking for undervaluation, in our case, between 20 to 30%. You need to be looking for shareholder, oriented management. And finally, and certainly not least, you need to have quality businesses. It's not enough as a value manager. We are a value manager to just look for undervaluation. You need to have a quality business because there need to be two drivers to your return: compounding above GDP, that allows you to still make money even while you're having to wait for the market to catch up and have that multiple re-rating, which is the second and more classic sort of driver of returns for value. So that's it in terms of my comments. I'll pause there for any questions, but you can see on the screen, I believe, the results that we've achieved over time. We're having strong results here against both the core index and also against the value index, but I'm conscious I think I'm over my time there, so I'll stop, Eugene.
Andrew, it's always in the numbers, but I want to ask Dan just to go back to one slide with the regional allocations very quickly, and maybe just to get a little bit more into how you see the world, because I mean, if I look at the regional allocations, you cover a very big universe of stocks. It is a highly concentrated or high concentration portfolio, but if I look at the holdings and exposure, how do you manage in Artisan Partners to cover such a big universe? What does that team look like?
Yeah, so if maybe Dan can take us back to the team, because I think it's a very fair question, Eugene. So there's really two different ways in which our industry tends to look at research. There's what we call the flow model. And again, we've trademarked that, but essentially what I mean by that is the following: you believe that if you have enough resources, you can capture the flow better than others. You can capture every last bit of information that might come out of a company's mouth or not, and you can factor that in and get some sort of information advantage by having more resources to capture every information flow. We believe that is somewhat foolhardy. We believe that is, frankly, something that's almost impossible. And indeed, you cannot just keep applying more and more research analysts to a problem in the hope you're going to capture an extra edge, especially with models, AI models out there now. I think, you can capture information in different ways using technology these days than you could before. And indeed, that's not the edge. The edge here is the insight, not the information. It's the insight. And the insight in our mind comes from an inventory model of research. And what I mean by that is, our organization is 6 people, right? And you may think, well, that's a very small number of people to cover the whole world market. But when you're only looking for companies that have strong business quality, they're undervalued by 20% or more, they have shareholder-oriented management, they have phenomenal balance sheets, you're not looking at the whole market. you're actually looking at a tiny subset of the whole market that actually meets those 4 criteria broadly. And so when you take that approach, you've actually got a stock inventory of those companies that you like, great businesses, world-class businesses that you like, that are run by good management teams. And often there's a catalyst that's needed to bring it into the portfolio, but it's actually a very small number of companies that would qualify against our very stringent 4-dimensional criteria. And that allows us to run this with a small team. The second point I'd make is we prefer small teams. There is a cost to larger teams in our experience. You know, when people hire Artisan's global value team, they're hiring it for Dan and they're hiring it for Mike primarily. You want to have a situation where the leaders, the people who came up with the philosophy and the process behind the strategy and have run it since its inception, and Dan's been the founding and lead PM since inception on this strategy in 2007. You want those people to be the ones, you know, heavily involved in all aspects of this business, not receiving a stock idea under the door from an analyst that's distanced from them, but actually in the weeds, properly doing the DD and building the models with the analysts. The analysts are an extension of Dan and Mike, and we think that's only possible in a small team. And we you know, bluntly, this is by design.
Andrew, thank you for that. Sharing a bit more insight into your business, I think, is very important for our audience to also understand your approach and where those numbers come from. We're very much over time. I want to thank you for your time this morning. You've got a very busy day ahead as well. I know you're going to jump off the call now, and we wish you a lot of success for your day ahead and your travels, and looking forward to seeing a lot more of Artisan on our sessions going forward. Thank you so much.
That's great. Thanks, Eugene. Thanks, everyone. Bye.
Right, for our next speaker, we are going to look at emerging markets, and who better to do so than Kevin Austin, all the way from Abu Dhabi. Good morning, Kevin. Really good for you to join us this morning. How are you keeping?
Good morning, Eugene. Thank you. Thank you for having me on. I'm doing well.
Thank you for waiting patiently. We did step over a little bit over our time, but you've got your full allocation, and you are ready to start if you've got the slides.
Yeah, I'm going to go ahead and share my screen, and
Yeah.
hopefully you can all see that now. Great.
Yeah, perfect.
Well, thank you. Thank you all for joining today. My name is Kevin Austin. I'm with GKG Partners, and just as a reminder, GKG Partners is a boutique investment management firm headquartered in Fort Lauderdale, Florida, with offices in New York and here in Abu Dhabi and a couple other cities around the world. We run about 160 odd billion at the end of the year. And so I thought I would maybe shift gears. I know, you know, this is now, I've done this several quarters in a row, and I think, you know, we run global equities. And so sometimes I'll talk a little bit more about developed and the AI, and I want to start off with that. And those who follow us closely probably would have noticed that our relative performance has struggled over the course of the last year, the trailing year, as we stepped away from you know, the technology stocks that we own that had done well prior to last year, after sort of the DeepSeek announcement, and just starting to see the deteriorating fundamentals and valuations increase. That's sort of our goal. And our investment philosophy, just to remind those, is really to do better with less risk, to outperform, to deliver alpha with lower risk, meaning we want to avoid going down, you know, when the market downdrafts. And throughout our history, Rajiv Jain, who's our CIO, has been able to outperform at every single significant bear market that he's invested in over the last almost 30 years now. And so we started to get concerned with the over-earning that we were seeing in the technology space. The valuations in the space are getting near, especially when you look at things like price to sales, are getting very frothy. And so we stepped away from that, but that was proved now to be early, but also just not only within the technology ecosystem, which goes beyond just this sort of standard technology, semiconductors, software, those sort of things, but also into industrials now and unregulated utilities, which are also sort of part of this. And you can see now the concentrated nature of this sort of monolithic trade has gotten to to extreme levels in terms of the S&P 500, which you can see here, where you have sort of now 40% is in in the sort of top 10, maybe the Mag 7, if you will, which a lot of those are those technology companies that are riding this AI wave. You think about what is passive investing? This isn't, I think, when academics, Burton Malkiel and Harry Markowitz, when they were sort of developing the modern portfolio theories and passive investing, they didn't, I don't think, foresaw that, in fact, these indexes cap weighted index can become very concentrated, as we've seen now. And not only are you sort of seeing that, in terms of just equity markets, but it's going beyond that. It's going beyond that, and now you can see sort of we've sort of coupled the tech and tech related companies, those other sort of parts of the market that are being sort of benefiting and being part of this AI ecosystem, the ones that I mentioned, are now 50% of the market. And not only just the equity market, though. If you look at now, it's the largest sector in private credit. It's the largest sector in public credit. And so you have now a full concentrated bet in a lot of different markets. I think that was one of the arguments that people were making, is that this is being funded fully by free cash flow coming out of these hyperscalers. But that's not true anymore. Meta borrowed $30 billion in an offshore vehicle to fund their big data center in Louisiana. And so this is now being fueled, I mean, there still is a lot of cash flow being put into this, but also the fact that it is being funded by debt. 50% of the data center growth in the US now is small companies, not hyperscalers, that are purely being funded by venture capital and private credit. And now you see, and look at the blue line on that, defensive sectors, which is where we've sort of positioned a lot of our portfolio into, to sort of be defensive, where we can see very consistent earnings, where we can be comfortable with the valuation that we're paying. Either it's a close to a historical multiple, or in many cases a discount to its historical multiple for some of these sectors. And they're now at their historic lows, which just gives us a lot of confidence. If you go back to prior bubbles throughout history, and you see the defensive sectors, they've actually performed well, even on an absolute basis, when we've had a significant downdraft, which is where we think we're heading. And so we've actually in our US strategy and in our global strategy, actually exhibiting negative correlation, which I think is pretty hard to do. I didn't even know it was possible to do that for a long-only equity manager. But we now are seeing, again, this monolithic trade keep pushing higher, and a lot of complacency out there. We are constantly challenging this, this thesis around the fact that that we think that not only the deteriorating fundamentals in terms of revenues to sort of support this, but also just the capital intensity of the business. Hyperscalers used to be throwing off lots of free cash flow, but now look at Amazon. Their free cash flow is down 70% year over year because they're now on a treadmill. Now they're eating into their ability to buy back stock, which ultimately will impact their earnings, because they have to buy back a certain amount of stock just to offset the dilution from stock-based compensation programs. And so again, looking at the business in totality, it's deteriorating. The quality, it's much more capital intensive. It's a much different business, and it's much more competitive. You used to have two hyperscalers, really, Microsoft and Microsoft Azure and Amazon AWS. Those were the two players for a long period of time. Now you have many players. You have Oracle stepping into the market and cutting prices up to 40-50%. And that is one of the most debt-fueled companies out there, but they're cutting prices. And so you're seeing pricing come down. We've done a lot of work from our investigative journalists calling around, talking to companies that are resellers of NVIDIA chips and saying, hey, what does the pricing look like for NVIDIA chips? And the narrative that, I think is being told to the world is that there's a huge scarcity in GPUs, but we were able to buy some. We can buy some for delivery. We can buy the not the latest generation, not the latest generation chips, but the previous generation chips for a 20 to 30% discount for delivery in the next couple of days. And you can get the Blackwell chips, the latest sort of product, not as quickly and not as big of a discount, but you can get them within a reasonable amount of time. And so the narrative that these are in huge scarcity, we're seeing GPU pricing drop down from these hyperscalers, because you have now a whole slew of neo cloud operators in the market that are eating away at the market share, and it's just becoming a more crowded space. In fact, there was an article in the Financial Times yesterday, announcing that TikTok, ByteDance, is getting into the data center when you're already seeing overcapacity in China. And so I don't want to rehash all of the things that I talked about, last time, but suffice to say, we've continued to dig, continue to look at this, and really are getting more and more negative feedback in terms of data points of what's going on within the AI narrative. And so we continue to be comfortable with, even though it's cost us a lot of relative performance over the course of the last year, continue to be very comfortable with our positioning. And we see days like yesterday where, we make up a lot of ground relative to the benchmark, and in some cases have positive performance in a very negative tape. But let's switch gears for a minute and talk a little bit more about emerging markets, because we also have a large part of our business in emerging markets, and which has also struggled to some extent because we favored areas of the world that in some cases are, well, before I come to that, let me just touch on valuations. I forgot about this slide. So it's really tough to find places that are cheap to invest at this point in time. You can see, most areas of the world are in their 90th percentile, and the US is in its 97th or 98th percentile in terms of valuations. But when you look within the sectors, within areas of the world, you can find opportunities within India. India has always sort of been a market that trades at a premium valuation, given the premium growth. But we can find companies that are trading at reasonable valuations that are delivering good mid-teens growth. In fact, we can find a long list of companies that are growing rapidly in India and pay a reasonable valuation. But if you look at the top end of the market, companies like Hindustan Unilever, things like that, are trading at 50 times for, reasonable mid-single digit growth. But within sectors, you can find good opportunities as well. If you look at, deeply within, say, the utility sectors, unregulated utilities are trading at very steep valuations. Those are the ones that are benefiting from the AI exuberance. But regulated utilities, in many cases, are trading around their historical premium. So you have to look deeply within. I think the previous mentioned being very nimble and being adaptive to areas where you're finding good opportunities. That's how GQG operates. We run a very adaptive portfolio, very nimble, in trying to find those opportunities where we don't have to take a lot of valuation risk, and we can see very consistent earnings. We try to underwrite companies that are sort of in a high single digit, low double digit rate of return in this environment. If you include dividends plus earnings, that's kind of our line in the sand, if you will, call it 10%. We can find many of those companies where we don't have to pay an exuberant valuation for those. And even though they might be less than what we see in the US, they're very expensive relative to their history, really anywhere you look throughout the world. But now let's shift gears to the emerging markets area where, we've been underweight China for quite some period of time, actually going back all the way to I think 2022. We have, or maybe earlier than that, we've been underweight to China. A couple of reasons for that. One, the macro environment continues to deteriorate in our view, and you see the market continue to go straight up. One of the reasons is the national team, which is the Chinese government buying stocks explicitly in the marketplace, but also retail investors, levering up to getting back to near all-time highs in terms of margin debt. But then looking at the macro picture, it continues to deteriorate in our view, and you see fixed investment in all three sectors now, which has never really happened in China's history, where you saw, all three sectors being property, manufacturing. All of those sectors are now turning negative on a year-over-year basis, and you see both from the state and private fixed investment negative. And so this is, again, not something that we think is going to change very quickly. I think the nature of the economy, it's been very tough in terms of the deflation and pressures that they have, the savings rate of their citizens not spending money, not turning the economy into being a more consumptive economy, but also the fundamentals of businesses. You can see the consensus EPS estimates continue to drop. That's one of the things that is our sort of North Star. We look at earnings as being sort of the gravity, where stock prices ultimately over a long period of time will follow. expectations for China for corporate earnings, it's literally all out price wars in many industries. But some of the stocks have done a great job creating competition in the e-commerce businesses and food delivery businesses. Too good. In fact, there's so many players now, they're all grabbing for market share and they're cutting prices. And this happened in other industries in China before, in the steel industry, and they've tried to fix it. But it's very difficult to fix these types of issues, because the way you fix that is take capacity out of the system. And if you take capacity out of the system, that means people lose their jobs. And employment is one of the most important things, obviously, for the government. And so it's a very difficult situation to fix when you have this situation. And then you see government bond yields at very low levels, indicating almost recessionary levels at this point. But if you look at an individual company, I mentioned this, earnings are going one way, multiples are going the other way. Alibaba, obviously a poster child for the AI trade, but the fundamentals of the business are going the opposite direction. Not only free cash flow, EBITDA growth, but earnings growth are falling off a cliff. Yet the stock continues to go up. And JD, another sort of e-commerce business, same situation, although the stock hasn't done quite as well. But again, this price war just driving and making it very tough for these companies to do business. And it's not cheap anymore. It used to be cheap. A year and a half ago, things were pretty cheap, and there might have been more opportunities there to find, but it's not cheap anymore. And especially when you look at it relative to places like India, which is an area that we favored, and we have an overweight to India in our emerging markets, and we have some of the same stocks in our global strategies. Where you see earnings estimates rising, you see actually fundamentals. It's the largest country in the world. It's the fastest growing large economy of the world. Yeah, they've had a little bit of a hiccup here and there over the course of last year, but still growing very rapidly and now outperforming. Yet the outflows from India have really, really hurt the stock prices. In fact, it's underperformed. It underperformed the MSCI EM index by 30% last year. That's the largest underperformance in over 30 years. And so again, not sort of fundamentally based. We saw multiples contract there to some extent. And again, there has been some hiccups, but it's really been a funding source for foreign investment flows going into China. We started to see that stem a little bit in the back half of last year, but it clearly hasn't reversed. And hopefully, now that things have stabilized to some extent in their economy, that people will look back to India and see we can find a long list of very high quality companies. In fact, in our emerging market strategy, we have exposure to every single economic sector within India, because we find great opportunities across the board there. And you can see it, valuations now, and India has always been accused of being a very expensive market. It's expensive, but for a good reason. It has really good growth prospects, but now it's sort of back in line, and it's actually really close to its historical average. So you're not paying a huge premium relative to history, but you're getting very good growth. And what we can see in terms of what we're looking for. Again, we can find a long list. If you look at even some of the stocks like the Indian outsourcing, the consulting technology business, which we have been out of for a long period of time, those are starting to become more attractive, because actually they are proving to be able to help people figure out ways to use AI. And so it's becoming now sort of, it was viewed as a negative, now becoming a positive for those types of companies. And so we continue to find great opportunities in India, great opportunities in Brazil, which actually, has finally sort of shrugged off some of the concerns about the political concerns with Lula and that administration, and the stocks have done pretty well in Brazil. Those are our two big overweights in India. One other area which is a bit troubling for us last year on a relative basis was Korea. And Korea is really dominated by the highly cyclical business. In fact, it's one of the most cyclical markets in the world. You can see sort of we're getting back to sort of peakish valuations and peakish multiples, and it is a very cyclical market. You take two of the biggest companies, Samsung and SK Hynix, are two memory companies, and if many people don't recall, gross margins were negative in the memory industry in the last downturn. Not operating profits, but gross margins actually went negative during the last downturn in memory. It is one of the most cyclical businesses in the entire world, but it's being priced now because of this AI enthusiasm like it's going to go on forever. There is a node switch to high bandwidth memory because that's what's being used for AI. But that's also crimped the pricing now for the sort of more traditional NAND and DRAM memory, which is the more traditional memory that's used in laptops and smartphones and things. But pricing has gone through the ceiling. But we saw this. This is a very late cycle phenomenon for this type of industry. And if you read, sell side reports, a couple months, a couple quarters before, everything collapsed, it was saying the same thing, that we can see demand out in the next 2 years, but everybody expects it to be quite different this time around. And so we are very cautious. We have owned Samsung. We've owned SK Hynix in the past, but we're very cautious. However, the Korean market has gotten quite frothy, and it is very cyclical. And the top line growth again is poor. But the price to sales ratio, as I mentioned before, price to sales is an interesting notion, especially when you get into sort of large cap businesses, primarily in the US, but also throughout the world, because it's very indicative of a negative outcome. When you pay, a large price to sales, call it, high sort of 8, 9, 10, or even north of that almost exclusively, for large cap companies, mid and small cap companies can sort of outgrow that type of multiple. But when you get into large businesses, diversified businesses, big companies, it's almost universally negative in terms of being able to deliver. I think a company that we like to use, or I like to use an example is Adobe. You paid 5 years ago, you paid, I think it was 11, 12 times price to sales. The stock collapsed 80%. But they delivered on their revenue growth. They delivered on their earnings, but you just paid too much for it, and the stock did not keep up. So why do we like India? Again, we can see very consistent long-term earnings trend, very, again, attractive valuations with a very stable earnings growth, a very stable political environment. You can see the reforms that they've made in India. They sort of have this big bang reform. They last in the back half of last year. They reformed banking regulations, financial services regulations. They reformed their labor laws. They have a lot of red tape and a myriad of labor laws that they've all reformed down to a much more simplistic structure. And then lastly, they reformed their sales tax, or goods and sales tax, which makes it much more simpler for people. Unfortunately, they did announce a big tobacco tax right at the end of the year, which impacted the tobacco companies, ITC, which is a tobacco company in India, the largest tobacco company in India. So unfortunately, we trimmed that back a little bit, but it will impact the volumes in the tobacco business for some time. And I know I'm sort of getting a little late on my time here, so let me just wrap up with this one. But the last point on India relative to China companies have not grown in a decade. And that is, again, our North Star. And so I'll keep there. You can see the relative disparity between India and China just from an earnings perspective.
Kevin, thank you very much. Perspectives on India versus China, very interesting indeed. I'm going to take one question from the audience very quickly because I know it's very topical at this stage because SA did extremely well. So how does SA feature into an investment destination by your valuation model as a EM region, especially considering where we are on off the grade list, etc.? Would you typically feature or look at this as an opportunity, or is it too small?
No, we look at everywhere. I wouldn't say it's too small. I mean, I think the liquidity, is for some of the large companies there, maybe Rand and some of the, and ironically, we actually do own Tencent, which Naspers, as you may know, is sort of benefits from their large, or I think it's 25% ownership in Tencent. And so that's something we've looked at. We haven't, we don't have any South African exposure in the portfolio currently, but it isn't a place that we would avoid. I think, just liquidity and certain things, that the structure and what we're looking for to sort of, get the exposures, though, we might just find a little bit easier way or maybe a more liquid way to play it outside of South Africa. But places like the UAE and places like South Africa, where we see a lot of reforms and we think things going from an economic perspective and a macro perspective are pretty good. We would definitely not avoid it, but we just don't have any exposure currently.
Kevin, thank you very much. There's still one or two open questions from the audience. We'll try to get that circulated through to you. Unfortunately, it's anonymous, but maybe we can circulate just general comments on that. Thank you so much for your time this morning, and good luck with the rest of the week. Thank you so much.
Appreciate it. Thank you, Eugene. Bye now.
All right, next up, we've got, like I always say, a high quality fund manager. Very well known to the audience, needs very little introduction. Richard Pitt from Blue Alpha. Good morning, Richard. Thank you for the time this morning. Thank you so much for joining us.
Eugene, good morning, and good morning to everyone who's dialed in, and thanks for making the time, and thanks to BCI for arranging this. Sorry to eat into your tea time. I hope you all have your coffees at hand. So yeah, I think thanks for the brief intro. Let's see if we can live up to that. I think the presentation. Sorry, just go back, Dan. Sorry. The title of the presentation is Time for Quality, and I think what I'm doing is I'm kind of giving the punchline away at the beginning. Most of you will know that quality has had a fairly tough time of late, and as quality managers, it's been rather challenging. So if we jump right in, and let me just give you the bad news first, which is performance. And given that our approach hangs firmly on this idea of investing in quality businesses, that is, businesses that generate high returns on invested capital, and given the knowledge that quality has not done that well recently, the returns are lackluster and perhaps shouldn't come as too much of a surprise. I think adding to the recent poor performance has been our overweight position in US stocks, which is not something, it's not especially by design, but I think it's just a function of where the screening takes us. And I think also, we like to invest in large cap, well-researched businesses where, we can get good financial information. And so with a lot of US exposure, we also, of course, have a lot of US dollar exposure. And we all know what's happened to the US dollar. So another factor which has contributed to challenging performance, of course, has been the fact that returns outside of the US, constant currency terms, have been excellent, somewhere between 15 and 8% percentage points ahead of the US. So all in all, I think no small irony, a tough year for us. And ironic that it was almost this time to the day, a year ago, that we were awarded the award from FundHub for the best 10-year performance. But that, I guess, is the nature of markets. Next slide, please, Dan. If we just look at what performance looks like longer term, I think you get a sort of slightly different perspective, simply because it's obvious when you look at a table, when you have one tough period, the last year, it affects all the numbers. But I think through time, what this slide shows is that our approach and philosophy has delivered very good returns versus the peer group through time. And that's about 2.5 percentage points annualized ahead. And that's notwithstanding the tough 12 months that we've just had. So what's up with quality? Next slide, please. What we're trying to show is the market backdrop of quality. And quality had a mediocre year. And I guess the challenge is that basically every major asset class was positive last year. The last time this happened was COVID. We'd also expect quality to do badly when value does well, kind of value growth story. And this has been sort of the case outside the US, but not really within the US. So digging a bit deeper, what we're showing here is the performance of quality, the top quintile of quality versus other styles. And if you focus just firstly on the the black line, which just shows quality versus the market, you can see kind of around the time of tariffs, it did quite well, and subsequently has derated by about 10%. And that alone explains almost all the underperformance in our portfolio. It's just that single factor. But I think digging a bit deep, it's interesting to compare quality to low quality, which is the blue line, and high quality to hyper growth. And obviously hyper growth is part of the whole AI story. And there you see since the April tariff period, a huge difference in return, huge underperformance, 36% and about 25%. And just to add insult to injury, even if you compare quality to another group called, just make them financially risky businesses with a high probability of default, certainly, they've underperformed by 4%, but if you take it from April, it's about 15% underperformance. So yeah, this is, if you go back 9 months, this is probably not what people would have expected, given all the uncertainty we faced, but I guess markets are always full of surprises. Next slide, please. We try to now, next, thank you, unpack this at a sort of stock level within the portfolio. And obviously, we had some companies that did very well. Last year at the global conference, one of the companies that we spoke about was Google. We were very excited about the business. We thought it was cheap. Some of the speakers have spoken about Google. And indeed, that did very well for us. We've had Broadcom, which did very well for us. But inevitably, it's the stocks that don't do well for you that really hinder your portfolio. So what we're showing on the left is stocks that we've had for some time, Booking.com, the global online travel platform, Accenture, and ServiceNow, which is a kind of enterprise workflow software as a service business. And the point to make, so we've aggregated the 3 businesses here, is if you look at the price relative, you can see the huge underperformance versus the world index. That's the blue line. And yet the earnings relative is actually going up. So, these businesses are not falling apart. There's a lot of questions about AI and how it affects them. In the case of Accenture, AI is actually a huge growth engine. Part of Accenture's business has grown 20 times in 3 years. So it's interesting to look at the operating results of these businesses versus the price performance. And we think these are quite interesting opportunities and businesses that we've had for some time and continue to have. But I think the bigger fault, the bigger error in our case was getting involved in new companies which had derated quite a lot by the middle of the year, and we thought were interesting opportunities. And examples are Adobe, Salesforce, and Deckers. Now, Deckers is a pretty straightforward business, footwear brand owner, as you know. And Adobe and CRM, they certainly are incorporating AI in their business models, but there is certainly a market opinion that AI is going to totally upend their businesses. But again, if you look at operating performance, this hasn't happened as yet. So this was part of the factor that contributed to the challenge for us in the last year. Next slide, please. In terms of quality, is now the time for quality. On the left, we're showing the performance of quality versus the rest of the market. And you can see from 2014 to 2024, tremendous outperformance, made quality as a style and approach very popular. We know the very successful international managers that run a quality approach and how they did for a long time. And on the right, we're showing the relative spread. And in hindsight, what we can see is that the popularity of quality actually pushed this area of the market to premium valuations versus history. Whereas now we've gone back to just kind of, you're paying no premium for quality, but for the quality style. And we think this makes quality as a kind of area of the market particularly interesting. The million-dollar question, we can go to the next slide, is which quality? And here I've pulled out Diageo. I think it's a very topical company. It's a classic high-quality consumer staples compounder. And it's been derating for about 3 years, as you can see. And it's also been promoted quite widely as a recovery opportunity. I mean, it looks relatively cheap. And I think the proxy that people are referring to would be British American Tobacco. which we're showing on the right. And you can see what happened in the case of British American Tobacco. It was cheap. They started improving returns, and and with that, the price did very well. Now, in the case of Diageo, we've got a new CEO, Dave Lewis, who was involved in the turnaround of Tesco, who's also known as Drastic Dave. And, I think it's one to watch, but I would just caution that until you actually see an operational turnaround, be very, very careful of getting involved in companies like this. The key on Noble, I guess, is the reduction in drinking, particularly in youth. Is the secular, or is it secular in nature? And that we don't know. What we do know is if you take the top 5 listed spirit companies, they are sitting on about $22 billion of aging spirits. And on average, this is in excess of 40% of sales. So that's a very, very challenging environment. Next slide, please. Continuing with the idea of Diageo and looking at a stock which we do own. We haven't owned it for a long time. We bought it about 6 months ago after it fell a lot, Novo Nordisk. And we bought it and continue to see it derate. But we think Novo is a very, very interesting business. And for us, much more interesting than Diageo. So as you know, it's the global leader in diabetic and obesity care. A quality business for sure. Issues, production constraints, given the demand for their product. Compounding pharmacies in the US, which is basically supplying great product. US pricing and access issues, and obviously competition from Eli Lilly, which their products achieved a better weight loss. So unsurprisingly, they've lost market share. Earnings have flatlined, and there's been a significant derating of the company. Next slide, please. If we now jump in and look at the business, I mean, on the left, we're showing the EPS and the rating. The rating's a little bit higher now, maybe it's high teens, but clearly you can see the earnings has kind of stalled in terms of growth. But I think what's really interesting on the right, if you look at the total obesity market size and growth, it's not that Novo is not growing. It's just growing a lot less than, say, Eli. So, there is still growth, and I think there's still a huge opportunity. There are something like 900 million people with obesity in the world. I'm sure there are probably more, and only 2 million are treated. So there's a huge untapped market. In the case of Novo, I think that the PE multiple is probably at the same levels before Ozempic, so before this whole obesity thing started. And importantly, we also have the launch of the oral pill, and I think that's going to open up a whole new market, different price point, easy access. It's been approved in the US, and in fact, the oral pill shows higher weight loss than Lilly at this stage. So I think there's a very good chance of us seeing some operational momentum in this business. Next slide, please. Next slide, please. And then another comp to something more topical. Microsoft, a business we've had for a long, long time. It fits also into the AI story. No, sorry, back please. Microsoft. Back, please. Thank you. And just to show again versus Diageo, Diageo, you've got significant. Sorry, I need to be on the next slide, please.
Yeah, Richard, sorry for that. I think there's a bit of a delay on Dan's side. Yeah, there we go.
I've got the Diageo and Microsoft one, yeah?
Yeah. Sorry, Richard.
So, I mean, if you think about Microsoft over the last 2 years, EPS relative has gone up about 15%. Price relative has declined about 20% versus the world index. And, we don't have to go back that far. Just think about the CrowdStrike patch update, how that impacted Windows. That was in 2024. There was a huge shutdown for a period of time. So our reliance on something like Microsoft, I think, is massively underrated for businesses. Obviously, they're investing in AI, and across the board, people are thinking about that. Last quarter, revenues up 18%, operating profit up 24%, strong net cash position, and free cash flow up 33%. So, really good business. And I've used Copilot, and I'm sure many of you do. And I think if you look at Microsoft, it is so well positioned in terms of using AI to hook their client base in even deeper than they are now. So, really good business. Next slide, please. Just very briefly, Diageo versus MasterCard, also been derating, business we've owned for a long time. You can see it generates far higher returns than a Diageo. The news affecting this company right now, I guess, as you know, it's a duopoly, is about credit card interest rate caps that Trump's been talking about. And the risk there is not kind of first order, because they don't charge interest, but second order in terms of processing volume. And I would just say, I think, the odds of that being enacted are extremely low, because if they do that, what's going to happen is there's going to be a huge deprivation of credit available to people in the US. So, yeah. Next slide, please, is Artisan Networks. This is kind of how we also trying to play the AI story. There's a lot of madness in AI, but I think there is and there will continue to be a lot of structural AI data spend. This is a company that benefits hugely from that. It has a market leadership in high-speed data center switches. And perhaps the most important chart for me here is just the one comparing it to Cisco, where you can see how they have expanded their market share. And companies expand market share because they have good products. As simple as that. So really good business, good financial quality, good margins, and something that we are happy to have in the portfolio. Next slide, please. So this just a chart we always show of the factors where we overweight, versus the indices. And you can see we are very skew quality, very overweight quality, overweight some operational momentum. If anything, we would like to push up the growth vector more, because the ideal is to find companies that are generating high returns and can reinvest that money. If they can't reinvest it, then reduce the share count. And you still have a good business with a lower equity component. But that's what the kind of portfolio from a sort of really top level looks like at the moment. And our focus is to continue looking for growth, but not push up the relative valuation too much. Next slide, please. And then just long term, I mean, we're all very focused on the short term, tariffs, Greenland, all these things. But if you look back through time, what the data shows you, certainly on a risk return basis, is that high quality growth is a very, very good place to invest money. And this makes, I guess, good business sense as well. There's nothing like owning a business yourself, not a listed company, but you own a business and you see what returns it generates for you, cash returns, and you will very quickly have a sense of whether you have a good business or not. So, that's kind of like the backdrop that I think guides us going forward. But nothing works all the time. And then last slide, please. I think, I've probably gone over my time, but I think, obviously we are quality managers. So for us, we will, we're going to argue the point that the time is ripe for quality. We think there are a lot of businesses that are looking very interesting. I'm sure you're all familiar with the program Succession and Logan Roy, the patriarch, and his comment to his children who are trying to take over his business. And I think, the world is filled with a lot of people who are not that serious. I mean, non-profitable tech rose about 50% last year. We know that SPACs are back. Leverage is widespread, and you can buy it in highly levered ETFs as well. There are many AI companies with zero revenue and high valuations. I guess Palantir would be the sort of poster child of that, at 100 times revenue. There's a lot of circular financing going on. It's well documented between OpenAI, Oracle, NVIDIA. And then you have strange stories like Carvana, the online car dealer, which has gone from near bankruptcy kind of 3 years ago to a 100-fold increase in market cap, and now trades on 85 times earnings. So this is a company with lots of concerns around financial manipulation, regulatory violations, high-risk lending, soaring delinquencies, and basically what they do is they are a funding business. I mean, at a huge valuation. So, if we could just lean a bit on Warren Buffett, I would say now is certainly the time to be a romantic, not to be a one-night stand person, and for us now is the time for quality. Thank you.
Richard, thank you very much for that. And we've seen a couple of presentations from you in the past, how it's all about return on equity. And I mean, the numbers are very clear. Return on equity in your portfolio is still extremely healthy. And that should be the focus. I'm going to take one question from the audience very quickly. And with regards to quality, it reads, do you not deem some of the hyperscalers as top quality? And if not, where do they fall over versus your quality matrix?
Well, we have Google. I mean, Google is one of our large positions still. It was a pick that we highlighted at the global conference last year, and that did very well for us. We still like the business, and I think that kind of fits into the hyperscalers. I mean, I heard the comments about Amazon. We actually like Amazon. I think if you consider how AI can impact both the likes of Meta and Amazon, they can be vastly different businesses going forward. And even Microsoft, it's one thing to look at these new AI businesses, but I think large developed companies that already have reach, they already own the client, and they can apply AI into that network. I think it's just going to make them stronger going forward. And of course, they have the cash to do it. I mean, yes, now sometimes the funding is partly with debt, but they still generate lots of cash, which can be invested into this area.
Over many decades, you've stood your clients very well, Richard, and not to be rated by 1 year's tough performance. And I do buy the story about, it is time for quality. And like I said, your ROE in your fund's still very healthy. And it's almost that old remark of don't throw the baby out with the bathwater. Richard, thank you so much for your time this morning. Always great to have you on board. And we'll keep conversations open through the rest of the year. Thank you so much.
Thanks, Eugene.
Right, but let's continue. It is my pleasure to welcome Shane Denahey, all the way from Jersey, and portfolio manager from Capital International. And Shane, maybe just by way of introduction, you're previously known as Martello Asset Management, so you did have a name change, and we're very familiar with your colleague and Chief Investment Officer Gary Hill, who presented at so many conferences. So we welcome you with open arms to our online session as well. And thank you very much for your time this morning. If you can maybe just briefly explain to the audience why the name change.
So Capital was the acquiring company. The fund maintains the Martello name and brand, same philosophy, same investment process, but Capital is the acquiring company, and that's the name that's going forward.
Fantastic, Shane. Thank you so much. We are ready for you.
Thank you very much, Eugene, and thanks for both dialing in. Good morning. So just some basic information on the fund. It is a high conviction, fairly concentrated portfolio of stocks, typically between 25 and 30 holdings at any given time. We have some other tidbits of information there on the fund, AUM, inception date, etc. So looking back over the last 12 months, there's been a lot of change, a lot of volatility. We've had the second coming of Trump to contend with and everything that entails. We've had trade restrictions, the ongoing conflict with Ukraine and Russia. But there are some things that have remained fairly consistent throughout the year, inflation being one of them. So this just shows US inflation throughout the last 10 years or so. So we're at about 2.7% at the start of last year. And again, we find ourselves about 2.7% this year. The expectation last year was for moderating inflation without any significant upticks throughout the year. And that's essentially exactly what's happened. Valuations are also on similar footings this year. The US did start at a more expensive point at the start of last year. It's in the same place this year as well. There was some good price appreciation in the US markets, but there was also some good earnings growth, so multiples didn't expand too much throughout the period. Emerging markets, the UK and Europe were on slightly more attractive valuations versus the wider market, as well as historical averages. and they have crept up ever so slightly throughout the last 12 months. A continuing trend that we've seen is obviously market concentration that has increased and sped up over the last 12 months, a continuing trend over the last 3 years. There's been a lot of money flowing to US mega cap technology stocks in particular, but we've noticed over the last 3 or so months that market breadth has started to broaden, to widen out to other markets such as the UK, Europe, EM, as well as other sectors like healthcare and materials that have been materially underinvested for the last couple of years or so. And you can see that market concentration is significantly above the 15-year historical average. And it just goes to show that diversification is very much additive, and it has been very much additive over the last 12 months. And that's what we've been seeing with the fund's performance. This just shows how the alpha that we did generate during 2025, where that came from and how it was generated. So you can see that the lion's share was from stock selection. We were able to eke out some positive return from the asset allocation, which is positive considering that the largest underweight we held during the year was technology. We had some overweights to healthcare, as well as energy stocks. So being able to eke out some positive return there was good. But again, the lion's share was from stock selection, so being in the right stocks regardless of the sector they were in. There's been a lot of news flow around AI, the multi-billion-dollar deals that have been announced over the next 3, 5, 10 years, building out the infrastructure for AI, the data centers, the power generation. The circular deals between the companies has been quite a key topic, but it does seem over the last couple of months, at least last couple of quarters, that there is more skepticism, more weight being applied to these deals, and how the companies that are doing these deals and benefiting from these deals, how they are able to sustainably keep spending this capex over the next 3 to 5 years. So this graph on the left just shows the amount of capex that the companies are spending relative to their revenue. So you can see broadly across the board that has increased over the last few years or so, but there is certainly certain companies that are better fundamentally equipped to carry on this capex expansion and increase over the next 3 to 5 years. And on the right table just shows the estimates of capex growth and revenue growth that are already baked in for 2026, the full year. So you can see on top of already increasing and fast increasing capex numbers, there's further growth baked in for the full year. And in certain cases, for certain companies, 2 to 3 times more so than their revenue growth. And this is just performance of some of the tech names that we hold, ASML, KLA, and Monolithic Power versus some of the well-known stocks within the sector. So you didn't have to own the most loved companies within the sector to still generate positive returns. And there were pockets of opportunity within the tech sector that were able to produce positive returns throughout the year. And one of our companies, KLA, is one of our, it's an AI beneficiary. So KLA make the machines that ensure the semiconductor production manufacturing process runs as efficiently as possible. They ensure optimal yields and minimal defects across the production line. So they benefit as there are more chips being produced and as the chips become more advanced and as the nodes become thinner and thinner. So they aren't too concerned with the end markets of where the semiconductors are going. They just care that more chips are being made and more advanced chips are being made, because it ensures that their machines become more critical to that production process. And of course, that does trickle down to excellent fundamentals. The margins have been accreting over the last few years, good revenue growth, good free cash flow growth, all from benefiting and exposure to the AI theme. ASML is a similar company. They make the machines that make the chips themselves. So akin to KLA, they benefit as there are more chips being produced, and as there are more advanced chips being produced, the need for their machines increases exponentially. And as the chips become more advanced, the machines to make those chips become massively more advanced as well. And again, ASML isn't too concerned about the end market of the chips. They benefit all the same. And that's all while having to deal with trade restrictions for their most advanced machines to certain countries like China. Defense spending. This has been a key topic for a number of months, especially with the ongoing conflict between Russia and Ukraine, as well as external factors like Trump's comments and chastising various NATO members for the amount they spend on defense. That's led NATO to upgrade their defense target as a percent of GDP. So the old target was 2%. That's been in place for the last decade. That's been increased to 5%, which is due to come into effect by 2035. So it's clear that the already increased amount being spent on defense is looking to increase quite substantially over the next decade or so. And this is the amount that's being spent per country. So you can see there are a number of countries that still haven't reached the 2% target that's already in place. Nearly all of them, bar Poland, due to its close proximity to Russia, are nowhere near the new 5% target. So you can clearly see there's quite a big spend and gap that needs to be filled, with some countries having to spend a lot more than others over the next 10 years or so. And as I said, that's on top of already increasing amounts of money being spent. So this just shows the countries, how much has been spent over the last 20 years. And you can see 63% increase from 2020 to 2025. And it looks like that trend is only going to increase over the next 10 years or so. One of the beneficiaries being Airbus, which we own in the fund. The large majority of their revenue and business is generated from commercial airline manufacturing. They've rebounded in that business segment very well from the pre-pandemic or post-pandemic declines. As more people are flying, more airlines are ordering planes. They benefited hugely from that. So they've nearly got back to their pre-pandemic delivery target. Currently at 793 planes delivered in 2025. They also generate roughly 20% of their revenue from defense. So as there's more defense contracts and more countries spending more on defense, Airbus has almost secondary exposure to that, which benefits the company on the back of their already strong commercial airline segment. And Rolls-Royce. So finally, Rolls-Royce benefits from multiple of the trends we've discussed today. They make small nuclear modular reactors, as well as microgrids for electricity generation. So as the ever power-hungry AI data centers are built out, Rolls-Royce benefits hugely from the need for external and different energy sources to fuel those and power those data centers. They also generate roughly 20 to 25% of their revenues from defense and defense contracts. So again, a second tailwind for the company and the fundamentals going forward. The company's also been a turnaround, been in a turnaround status for the last 3 to 5 years. There was a new CEO appointed in 2023 with a real focus on financial discipline, reducing the debt burden of the company, focusing on core businesses, and that has trickled down to excellent growth, both in earnings and free cash flow. Free cash flow has grown exponentially since 2017 to now 2024, and we're really seeing the benefits in the share price from holding that. But that's everything I've got for today, but happy to answer any questions. Thanks, Eugene.
Thank you so much, Shane. Very interesting indeed. I don't see any open questions from the audience. We will definitely stay in touch, and thank you for your time this morning in coming on the show. Thank you.
Thanks very much. Thanks, everyone.
Right, we are moving on, and again, another presenter that needs very little introduction, Sean Pesh from Radmore Fund Managers in the UK. Sean, good morning. How are you? Aha, you're still unmuted. After 5 years, Sean.
Sorry, Eugene. I was busy sorting out my camera. It's early here. I've only had one coffee. Right.
Sorry about that. Sean, you had a fantastic run in 2025. Please tell us you're going to do the same 2026.
Ooh, no promises. Let me take you through the presentation, and I'll let viewers decide. So I've got, all right. Well, look, thanks everybody. Thank you for your time and interest. And I'm going to tell a story that everybody understands. We all understand property, because I think there's some very important parallels to what's going on in the world today. And you wake up every morning and there's been a big change. So take yourselves back to 2017. It's after Brexit here in the UK, and you want to buy, and you're thinking about investing in property in the UK, all right? And so what we have here on the left-hand axis is average house price in the borough of Kensington and Chelsea, and this is from the UK House Price Index, where it's gone from £400,000 to £1.5 million. You'll remember that Brexit happened in mid-2016, and this is what a Chelsea place looks like. It's only the middle bit, and you don't get the Range Rover for £1.5 million, but you're a Liverpool supporter. And so you think, well, let's just go and have a look at what's happening in Liverpool. But your rental yield in Chelsea and Kensington is about 2.8%. Okay, so you have a look at Liverpool, and this is the same index, and you can see it's gone from 40,000 for the average home to 110,000. Much of that took place in from 2000 to 2006. And then it flatlined a little, okay? And that's what an average house in Liverpool looks like. But your rental yield is 8%, so you've got a higher rental yield. And if you put those two together and just compare them, you're paying £1.5 million for Chelsea, 110,000 in Liverpool, and this is what your historic returns would have looked like over 15 years. You've received 9% compounded just from capital appreciation in Kensington, Chelsea, 7% over 10 years, 8% over 5 years. And on Liverpool, that early rally contributed to some of those returns. You got 6% over 15 years, but nothing over 10 years, and 2% per annum over 5 years. And I think if you compare those, most people would have said, well, Kensington, Chelsea, far better looking house, higher quality, if you like, we'll go with that. So roll forward to the latest data, which is, just before that, you might have been worried about Brexit. And here's an article in the Financial Times in Feb 2017. So, some 8 months after the election or the referendum. And what it says the housing market cooled off the EU referendum, but more recently there have been signs of recovery. And there's no evidence of the stagnation in prices that the Treasury had predicted. Okay, so there was a little bit of a fall, but then a rebound, and you breathed a sigh of relief. Well, roll forward to October last year, and you're down 320,000 in capital on your Kensington and Chelsea place. You've lost 21%, and you're up 65% on your place in Liverpool. It's now worth 181. And if you include the rental yields and assume they stayed constant, you basically came out square. You've made no return in Kensington, Chelsea, and you've got about 130% return in Liverpool. Now, why am I telling you the story? Well, what happened here was that there were structural changes. You had Brexit, and what that did is it lowered demand from international buyers. Now, that didn't affect Liverpool because international buyers weren't buying in Liverpool, okay, but it did affect Kensington and Chelsea. You had higher property taxes on second homes. There was an additional levy that the government implemented on second homes. People weren't buying second homes in Liverpool. They were buying second homes in Chelsea because they live out in the country, and then they want a place in London when they come into the city, and that affected supply and demand. You had this non-dom regime, which is for foreigners who say that the UK is not their domicile. They don't have to pay tax on worldwide income. That regime was tightening. And so that meant a few people were like, well, I'm not going to hang around here. I'm going to go and live in Monaco or Jersey or Guernsey or whatever. And you had higher interest rates coming through. In 2017, you could get a mortgage for less than 1%. But they've obviously moved up. Now, that high interest rate affected everybody. But if you're only paying if you're only receiving a rental yield of 2.8 and you're paying a bit away in interest, you don't have as much margin of safety as you did in Liverpool. All right. So the key takeaway is that historic returns, this is what we think the key takeaway is. Historic returns become irrelevant when there's structural change. Okay. You can all look back and look at those historic performance numbers over those various periods. But when there's structural change, they become irrelevant, almost to the point of irrelevance. But avoiding those areas of structural change can be profitable because that's where the flow of money can go. So let's take a look today. That's what the MSCI North America looks like, 100 to nearly 700, done phenomenally well. Let's add the all-country world index, excluding the USA. So that's all markets outside the USA. You can see that even with this recent talk in the last year of American exceptionalism, there were times when America wasn't exceptional, and that from 2000 to 2007, people were far more positively disposed to countries outside the US than the US. So things change, but we have a recency bias. We just think about the recent times. All right. And if you look at the performance, 15 years, 13%, 10 year, 14, 13, and you look outside the world index, 6, 8, 8. And you'd argue, okay, maybe this is similar to the Kensington, Chelsea, and Liverpool example. Okay. But the question is, are there structural changes that we need to consider? Okay, and let's look at some of those. And we think that there are. If you look in the US, the Supreme Court independence is not questionable, and many scholars are saying it's politicized because the Republicans have got more Supreme Court judges there. The Federal Reserve independence is under threat. We saw, just over a week ago or so, Chairman Powell getting served criminal charges. There's this whole issue. The Economist talks about gunboat capitalism. In the latest article, latest edition, you'd see gunboat capitalism. And what that means is, okay, NVIDIA, we want a percentage of your revenue if we're going to sell some of these chips to China. There's talk about with military companies, and you look at Intel, they got a stake in Intel, etc. So this whole thing about if we do a deal with that country, then we're going to participate, and the government interfering with businesses is not something we've seen from the US. This disregarding of international law and kidnapping other presidents, and regardless of what you think about the politics, just the notion that they're invading other countries, and it means they're becoming an unreliable trading partner. The rules are changing. And I mean, we've seen just over the last week with this whole Greenland, and that Trump announced that he was going to impose another 10% tariffs on countries who opposed the Greenland idea. Well, they were almost at the point of ratifying a fully agreed comprehensive trade agreement. And so trade agreements are just being thrown out the window based on a whim. They've become an unreliable trading partner. And that has alienated long-term allies. And if you just look at the speeches made by Mark Carney yesterday, which is outstanding, I thought, and we should all read it, and Macron, what we've seen a step change. They've gone from pacifying America to actually saying this is how it's going to be, end of. And so that alienation of long-term allies, it is potentially a threat for the markets because, foreign countries and sovereign wealth funds and all the rest have huge stakes in US capital markets. And the question is, are we going to have free and fair elections? So we'd argue there are structural changes. And if that's the case, we might want to pay far less attention to the historic returns. Okay, so what can we do about it? Well, don't believe what I'm saying. This is PIMCO. This is the CIO of PIMCO. And a few days ago in the Financial Times, he published this when he was interviewed. And he said it's important to appreciate this administration is quite unpredictable. So what are we doing about it? We're diversifying. And we do think we're in a multi-year period of some diversification away from US assets. So this is the CIO of a $2.2 trillion American fund manager. Okay, what are the Europeans doing, etc. So I think we've got to be mindful of this. And if there is a diversification away from US assets, that is going to disrupt the supply and demand dynamics in the same way as the supply and demand dynamics were disrupted by the structural changes in Kensington. Okay, so how are South African investors diversified? Well, what I did is I took the regional weightings of the largest 10 feeder funds. This is the average of the 8 of them because 2 of them are fund of funds and they didn't publish their weightings. And you can see that on average, 69% of the assets of the largest feeder funds are exposed to North America, and actually less than 5% or around 5% exposed to Asia. Okay, this is the weighting in green of our feeder fund and our underlying fund. And so at the moment, we've actually got 20% in North America and far more exposure to Asia. And one of the reasons we've been gaining assets is because people have been using us as a blend, putting us in the portfolio and that lowering their effective weighting. Okay, if you look on a style box, and this is Morningstar style box, all the names are covered up, and that's why the box is a little bit smaller. But those of you who use Morningstar, I think it's an excellent product here. You've got value blend growth on the x-axis, you've got small, mid, and large on the y-axis, and that's us here, and that's the average, although those are all the other funds, the 10 largest feeder funds. And you can see they're all over there, blend and large, huge actually. All right, and that's our performance over the last year in dollars. Obviously, the strength of the rand affected the numbers for the world index, and we in rands had a good year, I'm pleased to say, and those are the percentiles. And we've managed to be, but the point is we've managed to generate those returns by being different, and being different hasn't negatively impacted us. And so we never know what's going to happen around the world. But one of the interesting measures is upside and downside capture, and that is what percentage of the return. So the upside capture is what percentage of the return in positive months do you capture? Well, over the last 10 years, we've captured 89%. So we haven't captured 100% of the upside, which is fine. We have we don't get swept away with euphoria and that. But importantly, we've only captured 77% of the negative market performance in down months. And you can see that our peers with the International Association Global benchmark over here is sort of 93% of the upside's been captured, so a little more than us, but more of the downside. And this is a shongololo, or a giant African millipede. And the idea here is we have a diversified portfolio. If a millipede loses a leg, the millipede can keep walking. Okay, and so that's why I've got a picture of that. That's what we talk about. We're not going to get everything right. It's a vastly, rapidly changing world. Trying to forecast the future is an impossibility if you diversified, and especially changes taking place. Maybe that's not a bad place to be. And then in terms of value for money, what you've got over here is the 2025 net performance on the x-axis. So this is after fees, and the TER is taken off the fact sheets on the y-axis. And if you look, we're over here. So we think we represent good value. And as a reminder, we don't charge performance fees. And as we grow, our management fee falls. So we can give some of that back to clients, and they can benefit in our scale. And so effectively, this is what you paid. This is what you got. Okay, and we think we represent good value for money over there. So we think maybe it's time to be different. All right, we invest differently, as you've seen. We perform differently, which blends well with portfolios. We charge differently. We're lowering our fees and don't charge performance fees. And importantly, we also give back differently. And so we're actually looking for charities for our Help More Trust Index, and you can read more about it on the website. And so if any of the viewers have firsthand knowledge of some great charities, small charities doing great things, please go to our charity website and propose a charity. So Eugene, can I leave it there?
Sean, thank you very much. And indeed, I actually looked at your website under Help More. So it's very interesting in what you do there for communities as well, and charities indeed. Question from the audience. We've seen your AUM grow massively over the past year. Has this had any impact on how your investment process and available stock picks work?
No, we don't think it has. And a couple of points on this. Firstly, at the beginning of last year, we were larger than multiples of the size than we've ever been. I think we were just over $400 million. And if you think back to when we, most of our history has been around 100 million, but we didn't generate our historic performance from playing in small caps that are liquid. They've always been the kind of companies we're in. So it's been scalable, and you can, so even with a starting AUM of 4 times historic average, we still had the year we did. I think if you also look at value investors, we typically buy too early and sell too early. So higher assets under management mean we buy more into the dip and we sell higher into the rally. And we play in a different space. So where we are, there's less competition. We are not chasing the AI tech stocks like everybody else. We're buying the stuff that nobody wants. So we play in a different space. And so, we don't think, well, certainly it hasn't affected our performance to date.
On that point, and I mean, it is a very strange world, and you touched on some of the issues, especially Trump, and you wrote a very interesting article on the unintended consequences of cobras in India. and the unintended consequences of Trump. And I think, that's top of mind if you look at the media lately. What are those unintended consequences of Trump going into 2026?
Well, one of them is that international fund managers, sovereign wealth funds, governments start lightening on US assets, which is exactly where everybody is invested. And what we've seen, for example, you've seen Japanese long-term bonds in recent days have spiked over 4%. Now, historically, the Japanese took money out of Japan because their bonds were yielding nothing, put it in US treasuries because they could get a few percent return. Okay, now you're getting attractive long-term rates in Japan, so the need to go to elsewhere in the world is less. And so, could you get a situation where people start repatriating money out of, and then Japan is the largest owner of US government bonds. It's the largest foreign owner of US government bonds. So there could be disruption. You could see European governments retaliate against the large tech companies, etc. The point is, everyone's got, they're all there. 70% of the assets and that's just the top 10 funds, feeder funds in South Africa. It's not unusual. Most of the world's assets are sitting in the US. And if there's a bit of a shift, then you're exposed. Would be our thing. So we don't know what's going to happen. No one can forecast the future. So the best way to protect your wealth is to be diversified, and to be diversified across regions and sectors and countries, etc. That's a good start.
John, very last question, and similar to what I've asked you in September 2025 at also the offshore webinar, August. And it's something that keeps on coming up because you've done so exceptionally well. And different to your investment strategy, I mean, you buy low, sell at fair value, making money for clients. But if you look at your fund, you ran hard. So some would say, but now I'm buying you high. I should be buying low. So, and your comments on that?
Yeah, well, look, if you're a buy and hold fund and the fund is up at the highs, effectively what that means is you're buying the underlying holdings at their highs because the fund continues to hold them. What we do is we sell when we think companies get to fair value, and then we rotate the capital. So if you go and have a look at the charts of our top 10, okay, you'll find none of them are close to their highs. You've got companies like Comcast, which have fallen, and Diageo and Greg's and all the rest. So, the companies that created that performance, in most part, have been sold. And we think that that's quite useful for investors, because as a new investor, you don't want to buy the old ideas that have already done well. You want to buy into a portfolio of fresh ideas. And the stocks are at the beginning of maybe, the upward trajectory, we would hope.
And you don't hang on to a company teeth and nails. If a company is doing well, you actually get rid of them. Sean, thank you very much. Very insightful indeed, and always great to have you on these sessions. Thank you so much for your time.
Thank you, Eugene. Thanks for the opportunity.
Yeah, all the best.
Bye-bye.
Right, we are moving on, and it's my pleasure to welcome to the audience Javier Panazzo, Portfolio Manager and Consumer Analyst at Nomura Asset Management. Good morning, Javier. How are you?
Hello, good morning. Happy to be here for the first time in the seminar.
Yeah, fantastic. Thank you so much for joining us. Very interesting indeed. Just very briefly, maybe just by way of introduction, you can maybe comment on that a bit more. In 2025, I saw a very interesting presentation that you did on how quality investing is changing, and very interested to understand your views on that and why that is part of your strategy. But let's go through your presentation, and you can maybe answer that as you progress. Thank you so much.
Thank you. So you go to the next slide. So as I was saying before, this is the first time I'm presenting. Back in August, Richard Cruz, he's also a portfolio manager in this fund. He was presenting a little bit about quality. So a little bit of an introduction for me. I'm the lead portfolio manager of this strategy, the Global High Conviction Strategy. I have been working at Nomura for the last almost 13 years now. I was previously an analyst at Orbis, so a bit different style there. And I'm originally from Spain. I moved to London back in 2008. I wanted to explain today a little bit of what's going on with the quality style, why we think the performance of the quality style has been a bit disappointing in the last 2 years, and why we think probably 2026 is an inflection point, and there are specific opportunities. So I wanted to focus in 2 sectors, consumer staples and healthcare. Last year, when I was in South Africa in a couple of conferences in Cape Town and Johannesburg, I was talking about the difference between consumer staples, a sector we don't like anymore, and IT, which is a sector like it used to be like more linked to growth, but we think there is a lot of quality in this sector. And today I wanted to explain consumer staples, we still don't like it, same problems we highlighted last year, and why we think healthcare is probably the right sector for 2026. And I'm going to talk a little bit about 4 of the stocks we have within healthcare. So we go to the next slide. So this is the track record of the strategy since we started 12 years ago. So as you can see, like the annual performance of the strategy has been 10.8% a year, which is around 100 bips higher than the benchmark, 9.8% every year. On the other side, 2025 has been the most challenging year since we started the strategy. So we finished the year nearly 10 percentage points behind the benchmark. So still a positive return of 12.5%, but has been a very disappointing year. We go to the next slide. This is the performance for every quarter of 2025. And you can see like, especially the first few quarters were pretty difficult for the strategy. We've seen a recent rebound in our relative performance. So the last quarter, we were more than 2.5 percentage points ahead of the benchmark. And the reason is, obviously, there has been a lot of headwinds for the quality strategy, and we start to see this is abating, and we are really hopeful about 2026. So if we go to the next slide, you can see this is basically what the benchmark says about quality. So the definition for the quality benchmark is companies with high return on equity, low leverage, and low earnings volatility. The broad benchmark is around 1,320 companies from 23 developed countries. And the smaller quality benchmark is the top 300 companies based on these 3 parameters. And the first thing you see, I mean, when you compare these 2 benchmarks, is like the quality sector is quite overweight healthcare, communication services, and consumer staples. At the same time, they are really underweight financials, consumer discretionary, and energy. And if we have a look at the performance of all the sectors for the last 5 years, we have been underweight if we invest in this quality benchmark, 2 of the best performing sectors, energy and financials. At the same time, we've been overweight 2 of the worst performing sectors, consumer staples and healthcare. If we go to the next slide, you can see the performance of the quality index compared to the broad index over the last, I think it's 38 years. So since December 1988. So you can see like the quality strategy has performed quite well. I mean, it's 4 times better, almost 4 times better than the broad index. But we have suffered 3 periods of underperformance. So the first one was in the early 90s with the invasion of Iraq. So defense, stocks, banks, before the global financial crisis was the second time. At that time, obviously, house builders, banks, real estate companies were skyrocketing. And the last period of underperformance has been the recent year and a half between June 24 and September 25. And if we go to the next slide, this is a sum of the last 5 years for the quality benchmark compared to the broad benchmark. And you can see the drawdown here is like 11% headwind in terms of a style for these 15 months. And you can see like from September 25, it seems like this has finished, hopefully, and we start to have a quality of performance again. So if we go to the next slide, I wanted to talk about two different sectors. So one of them, we still are quite negative about it. So same reasons I gave last year in my presentations, and the other one we are really hopeful about it. So the first one is consumer staples. We are not really exposed to it. We don't have any company here. We have a high conviction fund, so it's between 20 and 25 stocks. Right now there is 0 in consumer staples. And the reason why we don't like it is because there are a lot of structural headwinds. So if we just focus in one of the industries like food and beverage, which is one of the main industries for consumer staples, there are 4 main problems we see here. So that's in the next slide. So the first one is fragmentation of demand. So consumers now have a lot of choice, and they basically want products tailored to their needs. Compared to 30, 40 years ago, you can see like a lot of people have different allergies. They focus more on their health, so they don't want to have certain products at certain times. So it's much more difficult. I mean, in terms of like the demand has been fragmented quite a bit. You go to a supermarket, the supermarket has also embraced this, and there is a lot of different brands. It's cheaper than ever to launch a new brand, especially marketing on social media. So if you go to the milk aisle on a supermarket, that's the image here. You can see like so many varieties, different brands. That wasn't the case like 20, 30, 40 years ago. And this is increasing with online shopping. So that's another headwind, and it's structural again. Then we have the Ozempic effect. This is basically the GLP-1 drugs, increasingly popular in the US, also in Europe, but probably you started to see this in South Africa right now. So people taking these drugs, which are increasingly cheaper, they are not going to eat as much as before, and they probably will avoid processed foods, which are the most profitable products for these companies. Finally, this is more specific to the US, but we see similar trends in Europe. Is the Make America Healthy Again trend, which is basically supported by RFK Jr. So basically, I don't know, you've seen the news in the last 2 weeks. So the food pyramid basically disclosed a new one. So the focus is less processed food, more like natural foods, more protein. And I think it's going to change quite significantly. I mean, the products people are going to buy in the US, I mean, over the next 5-10 years. So there is a significant headwind from this. And these are 4 really strong headwinds, structural headwinds, which basically makes, I mean, a lot of these companies, which we thought 10 years ago or 20 years ago, they were really high quality companies, they probably won't be quality companies anymore. Next slide. And this is the healthcare sector, which again, it hasn't really worked over the last 5 years, especially since the perception was like Trump was going to win the election in the US. So basically by summer 2024. The problem here is obviously a lot of political uncertainty. On one side, you have all these trends from RFK Jr. He's also like trying to push changes in the healthcare sector. But there is also this rhetoric from Trump, like he's trying to address the high cost of living in the US. And healthcare is one of the main drivers of the increasing cost of living in the US. When Richard was presenting back in August, he was talking about the comparison of the different multiples of the different sectors. And healthcare at the time in summer, it was screening very cheap compared to its historical average, and also compared to the broad index. And we've seen in the last 3-4 months some rebound in healthcare, so it's started to perform better than the main benchmark. And this was, as Richard was predicting, so this is the typical pattern of Trump, like you have a big announcement, and in the following weeks, you have market-friendly clarification, some deals with some companies, and we've seen a lot of deals with big pharma companies about pricing. And this is basically creating the opportunity, I think, to buy on a really good valuation. So this is a great sector. The fundamentals are really strong. And if you look at the structural drivers of the sector, Obviously, the people in the US is increasing in age. I mean, they will have to spend more and more in healthcare. So the drivers are there. Is compared to consumer staples is the opposite. I wanted to highlight here the 4 holdings we have in healthcare because this is our main overweight in terms of sectors. So the first one is in the next slide, is Thermo Fisher Scientific. I have here the 4 holdings we own in healthcare. I sorted them by the date we started buying in our strategy. So we like Thermo Fisher a lot. This is our picks and shovels play. So they basically provide the tools for life sciences innovation. So instead of betting on one individual drug or one individual company, you're basically betting in the whole industry. 80% of the revenue is recurring, and you're exposed to this structural growth in cell therapy and drug discovery. So they benefit from the entire biopharma value chain. They had a difficult period if you look at the share price in the first half of 2025, but we started to see strong rebound in the last few months. The next one is AstraZeneca, is in next slide. So we added AstraZeneca. It was an opportunity in terms of price in September 2022. I also wanted to say some of the holdings is not the first time we own the holdings in the strategy. So for instance, AstraZeneca, this is the second time we bought it. Sometimes we decide to exit the positions based on the valuation is maybe full. We find better opportunities, or there is a risk which we are a bit worried about, and maybe it doesn't pan out. So we can go back to the holdings, or maybe they are cheaper than when we decided to exit. So the opportunity is there, and we keep an eye on all the companies we used to have in the strategy in the previous years, because obviously this study has been running for a long time. So AstraZeneca is our diversified pharma exposure. They have a portfolio approach. They cover oncology, the global leader in oncology, cardiovascular, and respiratory. And this reduces the patent cliff risk. They're basically targeting $80 billion in revenue by 2030, which means 8% growth a year in the top line. And this is supported by the strong R&D, which is around 20% of sales. And they have, when you look at the capital allocation, the reinvestment in the business is one of the best we've seen among these large pharma companies. If we go to the next slide, this is Boston Scientific. So this is our medtech play. They are focused on cardiovascular devices. Here, we are expecting mid-teens earnings per share growth for the next 5 years. And this is driven by innovations like the Farapulse electrophysiology system. When you look at their earnings growth, stands out among other medtech peers. And they also saw really interesting improvement in ROIC over the last 5 years. It's not here in this slide because I sent this last week, but they recently announced an acquisition. It's a company called Penumbra for around $15 billion. So obviously we are monitoring the situation because this is a big acquisition, but we think it makes sense strategically. The price paid is not outrageous. So, I mean, we are obviously keeping an eye on it, and we think it could pan out like a good acquisition. Maybe we look at this 2-3 years from now. And finally, the last one is the next slide is Zoetis. So this is the last company we added in healthcare. We took advantage of the price weakness. We added this position early in 2025. Zoetis is a spin-off from Pfizer in 2013. So they are the global leaders in animal health. 2/3 of sales are companion animals, so basically dogs and cats. And they are the market leader here. One of the big advantages of Zoetis is they're much, much larger than number 2 and number 3 in this market. So the level of R&D investment they have, I mean, staggering. So they've been basically pioneering new areas like new markets. They're now moving into cardiology, kidney disease, oncology. the track record is pretty good. And we have faith on this company. And obviously also at the same time, the valuation is quite attractive, especially like the market is a bit concerned about one of the drugs they launched recently, which is called Librela. So that basically gave us the opportunity to buy into Zoetis. And finally, and last slide here, number 14. Okay, so this is the fund or the strategy exposure for the different sectors. And you can see like the main overweight right now is healthcare, 6.5 percentage points more than the benchmark. On the other side, we don't have anything on consumer staples. And I think that's the main highlight of today. So we are quite encouraged about the opportunities in healthcare. We think quality is probably coming back this year, and happy to take any questions you have.
Yeah, very many thanks for that insightful indeed in terms of how you see the world of quality. Maybe just a quick question. It's a comment from one of the audience members, and it speaks to, nobody's really commented on the possible impact that Trump's tax reform will have in the US. And I mean, if it does succeed, you're looking for, estimated $150 billion going back into the system to consumers. How will that impact on some of these companies that you hold in your portfolio, should that come to be?
So we see the tax reform impacting the short term quite significantly. So if you look at the economic growth of the US, has been quite strong in the last few quarters and increasingly strong. But a significant part of this performance is based on less imports, more exports, and also increasing capital investment from the companies. And this is likely to continue in the first part of 2026. So we see like, obviously, because tax benefits, companies are going to increase CapEx a lot in the first months of 2026. The consumer is also going to be benefiting because obviously we have elections in November. And Trump knows the big thing with elections right now, the big concern is the cost of living crisis in the US. So he's doing whatever he can do to have some headlines, easy wins for November. So we've seen already like he's trying to cap the interest rate of credit cards at 10%. He's also trying to reduce the mortgage rates. So houses are maybe a little bit more affordable. He's trying to pressure house builders to build a little bit more. He's trying to change the mortgage market, maybe a different mortgage without the option to prepay. So it's going to be a bit cheaper. So a lot of options trying to have at least headlines or have the impression that he cares about the consumer. And obviously, at the same time, some tax returns and the policy of no taxes on tips, for instance. So we think the economy in the US is going to be strong, at least for the first half of the year. So consumer companies, especially those exposed to higher income consumers, I think are going to have a tailwind of this demand. And GDP growth, I think, in the US is going to be quite strong for the first few months. But to be honest, most of the companies we invest is not for the next quarter or two. It's like companies we think structurally for the next 5-10 years are good companies, and we buy them at a good valuation. So yes, we keep an eye on the macro, but it's not the reason why we buy something just to buy now and sell in 12 months.
All comes to bear, it is definitely an inflection point for quality. Javier, thank you very much for coming on this morning. We're really grateful for your time, and we'll keep the channels open. Thank you so much.
Thank you.
Right, for our last session this morning, we're a little bit behind on time, but Jared Khan from Credo Asset Management, you've got your full time. I'm not going to steal your time. It's really great to have you with us again, as always. You're someone that needs very little introduction to this audience, equity specialist at Credo. And as you guys put it, the fund manager that manages assets at the intersection of value and growth. Good to have you with us. Good morning.
Morning. Hi, Eugene. Nice to be here. It's value and quality, not value and growth. But yes, thanks for that.
There we go. Thank you for that.
Right, I'm going to kick it off. So if we can just move to the next slide. Welcome, everyone. Nice to be back. So I started my slide last year with this identical slide, Hello 2026. I took Gemini and I just updated it. And the S&P returned 16.4% in 2025. And over the past 3 years, the index has returned over 78%, making it one of the strongest 3-year performances since the late 1990s. And you can actually see it there. If you look at the lime green, you've got 2025. And then if you look at the aqua blue, you have 2023, 2024, and actually 2021. So we've actually been in a period over the last 5 years, if you exclude 2022, where we have extraordinary returns in the S&P. Just looking at some of the comments there, one of the analysts got it completely right. Goldman Sachs got it wrong. But generally, the point here is that when you've had 3 years of strong performance, one must expect that returns are going to be a little bit dampened in the following year. Next slide, please. But without sounding too bearish about things, there is still a lot of reason to be bullish. And some of these reasons include the fact that the US economy remains very strong. GDP is growing. Some of that growth is obviously coming out of capex, which we're going to talk a lot about today. Interest rates are coming down. The Fed on the short end certainly is expected to cut rates by probably 0.5% this year, 2 cuts of 0.25%. One of the big problems, though, for the US is the long bond. And Scott Bessent's working really hard to try and keep the 30-year Treasury down because that affects mortgages and that affects where a lot of the borrowing happens. Obviously, what's happened in the market overnight and with Japan is going to put stress on this. Inflation also appears to be under control. I was a little surprised by this. A lot of my presentations last year were about tariffs and how inflationary they were going to be. But to be honest, we haven't really seen that inflation in the US. And because of that, the Fed, although it's been cautious, has been able to actually cut rates. The AI revolution, the capex spend continues with immense momentum. And again, this is probably the biggest theme that we're going to talk about today and how important this is to the state of the US economy. Then lastly, the Trump put. In the old days, we used to call it the Fed put. I've called it the Trump put. While Donald Trump is still in charge, he cares immensely about the state of the US market, wants to make sure that everyone's kept sweet and that returns are positive. And I think he will do, although it doesn't seem like it with what he's been doing in Greenland lately and with some of those tariffs, but he will do whatever he can to try and ensure that the US stays on track and that the market actually does not become unhinged. Next slide, please. So, I always kind of show a slide in terms of which sectors performed well and which didn't. And again, it's deja vu. AI has dominated performance over the last year. And a lot of that performance has come out of 2 sectors, one being the semiconductor equipment. So companies like NVIDIA, Broadcom, Intel, AMD, huge returns through the year. And then the media and entertainment, which are companies, again, like Alphabet and Meta have done well. Interestingly, banks perform quite nicely. But on the flip side, if you look at the sectors that didn't perform well, healthcare, Procter & Gamble, consumer discretionary, like the last president was talking about, being a dull sector, and they've been under a lot of pressure. But effectively, all of your defensive sectors, which a lot of actually value stocks are sitting in. So 2 very different experiences. Although value performed in line with growth last year, but certainly the dominant theme continues to be AI. Next slide, please. So let's talk a little bit about this AI spend. So since ChatGPT was launched in 2022, 42 AI-linked stocks have driven 65 to 75% of the S&P returns, earnings, and capex. The hyperscalers have spent 1.3 trillion on AI capex and R&D since 2022, and the market capitalization of the 4 hyperscalers plus semiconductor players has risen from 3 trillion to 18 trillion and now represent over 20% of developed markets and 16% of global equities. which is a very important point. And then if you just look on the left side at the graphic, what you see here in the black block is the tech capex. That's 1.9% of GDP in the US last year. And if you add all of the 6 previous events, things like the broadband capex, interstate highway, Apollo project, et cetera, those 6 blocks altogether came out at about 2.1% of GDP. So you can just see how mammoth the actual infrastructure play is pushing capex and how it's pushing GDP growth in the US. And because of this reason, one has to kind of question what happens when the music stops or if capex starts sliding. And we're going to get onto that a little bit later in the presentation. So next slide, please. We talk about concentration risk, and it's been brought up in a few of the previous presentations. These are the 10 biggest companies in the S&P presently. And if you look at the graphic, again, going to the biggest bar on the far right, you see that mega cap tech and the AI era now constitute somewhere close to 40% of market capitalization, i.e. the market cap weighted index in the S&P 500. So when you think about it, really what you're doing is you're getting 10 of the biggest companies presenting 40% of your return. And of those 10 companies, I checked last night, 9 of them are all correlated to AI and the AI spend. The only one that isn't is Berkshire Hathaway. And again, this is unprecedented. We've talked about concentration risk in 22, 23, 24, and 25. We're now at new highs. So just be very cognizant of the fact that if you're in a passive index, you're not diversified at all. And that's probably one of the biggest themes that we'll talk about again today. Next slide, please. So given that CapEx spend and AI trade is so important to the index, so important to market returns, one needs to ask a few questions in terms of what could actually go wrong. And I've just pointed out 4 of them in this presentation. If we just move to the next slide. So the first one is about debt. Many people have compared this AI bubble to the TMT bubble of 2000, and they raised 2 points. One is about debt financing. And in this graph, all we're kind of showing is that the TMT cumulative growth in high yield and investment grade debt increased massively from 1997 to 2001, going from 38% to 187%. Whereas if we look today at the AI boom, that most of these hyperscalers and companies are using their own balance sheets and relying actually very little on investment grade debt. In fact, it's only increased by 9%. However, if we move to the next slide, it's a little bit disingenuous, because if we add things like special purpose vehicles and private credit, the growth in credit has actually grown exponentially and even larger than what we saw in the TMT bubble, moving from 20% in 23 to 240% in 2026. What's a little bit more worrying is not the size necessarily of the spend, but the opaqueness of it. So these special purpose vehicles, examples of that would be, say, for example, Meta spending 27 billion off balance sheet on one of its data centers. There's no reason for a company with such a pristine balance sheet to be, entering into kind of deals like that. Other examples are OpenAI's acquisition and purchase not only of chips from AMD, but an acquisition of a percentage in the actual company itself. So lots and lots of very new, ingenuitive ways and methods of using credit. And unfortunately, a lot of this is a little bit opaque and not really seen by the general public. We move to the next slide. So putting that into perspective, and here Morgan Stanley have come up with the spend in AI over the next 4 years. 2.9 trillion is needed for these data centers, of which 1.4 trillion is covered by the hyperscaler cash flows, strong balance sheets, and 200 billion in corporate debt. So we've got about 1.3 trillion that's going to be needed from other sources of debt capital. And these include things like ABSs, CMBSs, private credit, asset-backed finance, debt funding of joint ventures, and then private equity, VCs, sovereign. So the point I'm really making here is that the market is having to rely quite heavily on debt markets and on private credit and on companies like Blue Owl. And we're already starting to see a lot more discerning investment taking place. In fact, Blue Owl recently turned down a deal for another Oracle data center. They blamed it on the pricing wasn't good enough, and also on diversification. And you've also seen quite recently a lot of money is starting to leave the sector with concerns that there is actually potentially a bubble and a credit default looking to happen relatively soon. So next slide, please. So the second point about this, parallel to the TMT bubble is circular financing or vendor financing. And example most people use is Cisco lending money to the likes of Lucent and Nortel and all of the underlings, where they basically give them cash, allow them to buy all of their servers with the hope and expectation that they will grow out these businesses, make lots of profit, and then repay the loan. And lo and behold, what happened is they built it. There was overcapacity. They weren't able basically to generate any profits, and they all went bust. Cisco sustained severe losses, but actually survived. But I'm sure a lot of you have seen a graphic very similar to this on the left-hand side, which is really just an intricate web of inter-ownership and inter-parallel relationships between all of the big players in the AI space. The biggest culprit is OpenAI, which is a big beneficiary of the Stargate program. And OpenAI basically has just opened a checkbook and said, we're going to buy chips from NVIDIA, from AMD. We're going to take a stake in AMD. We're going to buy and support Oracle. Likewise, NVIDIA, just supports all other companies, CoreWeave, et cetera, Microsoft now owns 27% of OpenAI. And all I'm getting at is the correlations and the interrelationship here is actually quite dangerous. And to put into perspective, the sector is spending over 400 billion a year, but only bringing in 60 billion in revenue, with the gap filled by debt and circular financing. We have companies like CoreWeave spending 4 times what they earn using NVIDIA's money to buy NVIDIA chips. And then OpenAI, which we're going to talk about a lot in the next 2 slides, basically generating 10 or 20 billion, but needs 50 billion annually just for the Oracle contract, while it's losing, hand over fist every day. And only NVIDIA is the company that benefits from this, while everyone's buying their chips on debt, hoping for future profits. So next slide. Let's talk about the big elephant in the room, and this is OpenAI. And if you just look at the graphic, I've got Gemini to help me here. If you know House of Cards, Kevin Spacey is normally sitting in that chair, and I got Gemini to turn his face off and put on Sam Altman, make it look a little bit cocky. But really, OpenAI is the House of Cards. This is the one that one has to watch this year, and certainly if it's not by the end of this year, next year, in terms of does it bring the whole AI trade to a halt? It is the biggest individual corporate risk to the whole AI story. OpenAI is on track to make actually 20 billion in revenue. They're very proud a couple of days ago to announce that, but has commitments of over 1.4 trillion to its corporate partners to 2033, yet survives on subscription and developer AI fees alone, with a zero search advertising, cloud computing, or hardware revenue. This is a company that basically is relying on one trick at the moment, and that's ChatGPT. They had, the lion's share of that a few years ago, but as you've seen over the last, couple of months, they've kind of lost the consumer. Gemini has come in and has taken significant market share. And you've seen the likes of Apple, who was a big partner of them developing with Siri, have actually moved away from ChatGPT and chosen Gemini as their main source for Siri going forward. Likewise, on the enterprise, it was the go-to for coders. They're now completely losing market share to Anthropic. So 2 of their core businesses are effectively looking pretty weak. And Sam Altman has called a code red, last month or 2 months ago, basically saying we have to relook at this. We're getting our lunch eaten. And you're seeing also a big sea change. Microsoft, which owns 27% of the business, is kind of tied to the hip. Well, they're starting to move away. They've just given $5 billion to Anthropic, and they're looking at other sources of capital. On top of this, you have Elon Musk that's just sued the business for anywhere between 80 and 135 billion based on fraud or misrepresentation about them being a non-profit. And when Sam Altman was pushed on the question as how he's going to pay for all this debt, he just got into a bit of a hissy fit and said, Brad, if you want to sell your shares, I'll find you a buyer. Just enough. You really need to watch the clip. It's hysterical. And it really just goes to the fact that this business is looking a little bit dire at the moment. Just move to the next slide. So HSBC actually came up with a lovely graphic. This was taken, I think, halfway through last year, and it shows you the projected growth or funding gap that OpenAI actually need over the next 5 years. So this isn't even to 2033. This is just to 2030. And what you see on the left side is the blue lines, which is revenue, and the red lines, which is the total cost of cloud computing. In other words, the cost. And the little blue dots are where they have negative free cash flow. So every time you see the negative free cash flow go wider, they need to fill that gap. And the only way they can fill that gap is by an equity fund raising. So you see in 2026, the gap gets bigger. They do an equity fundraising. In 27, the gap gets even bigger. They do an equity fundraising. And 2028, it actually starts shrinking because they're getting their revenue up, et cetera, et cetera. The point being that over the next 4 years, they're going to have to do equity raises in the number of about 200 billion to close this black hole. And again, to put that into perspective, the biggest IPO that's ever been done in the markets to date was Saudi Aramco in 2019, and they raised just short of $30 billion. So what we're saying here is that over the next 4 years, if we equate that equally, you have to raise basically 30 to 40 billion on a business that at the moment is showing very little signs of turning massive profit, is losing market share, and is losing the confidence of the market. And this is probably the biggest risk, I think, to the AI trade. And when it comes to the last quarter of this year, where I think commitments to the likes of Oracle are going to have to be made, a lot of big questions are going to be asked around OpenAI. Next slide, please. But it's not only OpenAI. And if you remember the blue graphic where I talk about the intertwined relationships of all of these businesses, there's a lot of them that are tied to the hip. And Oracle is one of them. OpenAI have sponsored Oracle to the amount of 300 billion in orders for their products. And what you see here is the credit default swap rates of Oracle. So the blue line is basically the normal high yield, or actually investment grade yield credit default swap rates. And historically, what's actually happened is that Oracle used to be pristine. So going back to 21, 20, and just before they made a big acquisition and increased their debt, they used to borrow at much cheaper rates. Post the acquisition in 2022, they got their balance sheet back under control. And through 23, 24, and most of 2025, the business traded like it should have, except it is now committed billions to roll out of their infrastructure spend. And what you can see here is the cost of borrowing, or the cost of insuring, as we see it, in credit default swaps, has kind of gone up massively by over 100 basis points. So what we're really saying is the market understands these things. The market's cognizant of the fact that Oracle is massively over leveraged. And if OpenAI goes, then Oracle goes, CoreWeave goes. They're all not necessarily going to go bankrupt, but they're going to be significantly stressed and may need huge equity raises. Next slide, please. So hopefully we've covered the debt financing aspect, but another worry that the market is talking about, and maybe doesn't get enough press, is the fact that we have massive US power constraints, the risk of a power shortfall for US data centers. So you can have all the capex, you can have all the contracts in place, but without the power generation, you actually can't get anything done. And here, Morgan Stanley have produced what they think is needed in the power supply in the US from 2025 to 28, 69 gigawatts of capacity, of which 10 is under construction, 15 is available, and there's a shortfall of 44. But they come up with an assessment of alternative energy sources that could actually be implemented to make up that shortfall. And on the right side, you've got companies that have got these natural gas turbines, and that's why you have, GE Vernova, which is just shooting the lights out because this is an industrial business that happens to have this technology and everyone wants it. You have new technology like Bloom Energy, and if you look at that stock price, the stock's gone absolutely ballistic over the last 6 months. And you have like thermonuclear plants like Oklo, and then other Bitcoin sites that have been turned. They've been turned around from just Bitcoin generated to other sources of power. And effectively, if all of this goes well, they'll basically just be about to cover the electricity bill. And if it doesn't, which is actually quite a strong probability, because if you look at the environmental impact, the fact that no one wants these anywhere close to their counties, there's quite a lot that can actually go wrong in terms of the power generation. So this is one of the aspects that one needs to keep an eye on. You talk to Jensen, and he'll tell you that the chips that are being produced more efficiently, will need less power. And although there are bottlenecks in the future, this isn't going to be a serious concern, but something very much to keep your eye on. Next slide. The next slide is Chinese AI, and I've talked about this before, and maybe it's something we can put away for a while. But the only 2 points I want to make here are, first of all, the language learning models from China are getting more and more sophisticated every single day. You're also seeing massive downloads from Chinese entrepreneurs and developers. There are multiple more developers in China than there are in the US. It's just the law of big numbers. And the price of computing and the price of downloads in China is significantly cheaper than it is in the US. Companies like Moonshot and DeepSeek, fractions of the price of Claude and Grok, etc. So although one isn't concerned because at the moment they don't have the right chips, which are the NVIDIA chips, they are building a parallel universe where they're going to be using their own semiconductors. They have massive energy sources, and although it's not about the language learning models, it's also about inference. Because of their sophistication in the likes of robotics and EV, their usage is going to be potentially more sophisticated than what we're seeing in the West. And this can cause problems going forward for the AI trade. The other question is, US interventions in Venezuela, and whether this raises the right for China to basically go into Taiwan. I don't think Taiwan's actually a risk for a while because it doesn't suit China at the moment. And then we can move to the last slide on the AI trade. And this is the question of, the metaverse moment. What is the metaverse moment? It's the moment after spending billions of dollars on the metaverse that Zuckerberg realized that he can't actually make a return on his investment and cut capex spend. And that's when actually the Meta share price rallied significantly. And if we kind of move that parallel to what companies are doing today, can companies actually make a proper return on investment from their investment in AI? And the jury's out. There have been two significant reports, well, certainly one, which was in July 2025 by MIT from the Project Nanda group. And effectively what it said is that 95% of generative AI pilots fail to deliver measurable financial returns. Although there's wide adoption, there's been little transformation. The problem is lack of adaptability. Systems fail to learn from feedback, retain content, or integrate workflows. And the disruption that they found was actually in the tech and media sectors. And of the the 5 other sectors, including healthcare and financial, they didn't see any benefit. And again, one of the problems was that the budget allocation was misdirected, because the best return from investments actually back office automation, but most budget was spent on sales and marketing. And you fast forward another report that came out actually last week, and this is from Torsten Slock at Apollo. He's a chief economist, and he just makes the comment about the latest Duke CFO survey, where they surveyed some of the biggest CFOs in the US. And again, they're a very, very similar sentiment. They're seeing no impact from AI on labor productivity, decision-making speed, customer satisfaction, or time spent on high value-added tasks. So one may think it's great. I've used ChatGPT and I've used Gemini to do some funky stuff in terms of incorporating diagrams and researching stuff. But really, is it going to move the needle? And maybe on an individual basis it has, but the enterprise certainly hasn't. And the question is how much longer this CapEx spend is going to take place until some of the big hyperscalers or others turn around and say, it's just, the juice is just not worth the squeeze. Let's move on to the next slide. So wrapping it all up, what am I trying to get to? The market is significantly concentrated. The top 9 stocks in the S&P constitute nearly 40% of the index of the S&P. And as you see other global indexes, you have this AI trade that's been going on, that's been fantastic. If you've been a growth investor and you've been in things like semiconductor stocks that are historically very cyclical. But maybe this is the year where we need to think about diversification away from the big mega cap stocks and into other sectors, maybe an equal weighted S&P, or maybe different countries. So effectively what you want to be doing is buying funds, if you want to buy active funds, where the active share is very high. In other words, where the correlation or the correlation to the index is low, which brings us on to the Credo Global Equity Fund, which has about a 90% active share. So basically what we're saying is that if you look at our top 10 holdings, it doesn't resemble very significantly the S&P 500 top 10, etc. We just move to the next slide. Thank you. So again, it's about valuations. Where are our valuations expensive and where are they cheap? You've seen this before. The MSCI Growth Index is close to all-time highs. We've seen multiple expansion from all of these tech names. Although we've seen earnings growth, it's all really come in the multiple expansion. And you maybe want to get a little bit more downside protection going into 26 and 27, because as I say, we could see some rude awakenings when it comes to the US market, particularly around AI. Compare that to the MSCI World Index, also looking quite expensive, mainly because of the fact that you've got all of these large cap stocks that are pushing the index up. But the value index looking relatively cheap, and like that, the Global Equity Fund, valuation wise, on a blended basis, very much in line there at about 16 times. So we think we've got lots of downside protection should the market hit a bit of a wobble this year. And lastly, just to end off, I'll show you some of our top holdings and where we positioned. It hasn't changed much. If you follow the fund, you'll see that we remain underweight technology. Our biggest holding is Alphabet. We took a position in Alphabet at 160. It's been a good position for us, and we've actually been trimming that position somewhat. We do own 3 of the Mag 7, Alphabet, Meta, and Microsoft. We think Meta looks relatively cheap. If you look on a relative basis, it's the cheapest it's traded in many years. Market is worried about the capex spend there, and we get that, and so are we, and we're monitoring that. But we think the valuations are attractive. And then we own, quite a lot of stocks outside of the US. 61% is North American facing, but we have 14% in the UK, 22% in Europe. The likes of Ryanair, which is close to all-time high. We have companies like MTU, which is a great German civil aviation company. and others, defensive names like Progressive, British American Tobacco, and many insurance businesses. So we feel very comfortable going into 26 that we have a diversified portfolio. We don't have significant concentration risk in the AI trade, and we've seen periods of this before where value underperforms for quite considerable periods of time. And then when you do have, that kind of weakness in the market, that's where you have funds like ours that significantly outperform. So I think I'm going to leave it at that. And thank you for your time. And it's a pleasure to have been here with you in early January.
Jared, fantastic content as always, and it's been very insightful. And I think you hit the nail on the head as the last presentation for the day, and that is diversification remains key. I've actually seen that graphic on circular financing, and it does give me the heebie-jeebies every time I see it. The numbers are just a bit silly. Yeah, but we'll see how it plays out. I just want to test your views very quickly on China. We've had GQG presenting earlier on India versus China, not too positive on China. But if I look at the tech sector, and you've touched on it, I mean, the US are sitting with power constraints, and it's probably the biggest issue. China does not have that problem. And if you look at their hardware as well, they seem to be winning the hardware race. Could it be a case that if you were to back the AI theme going forward over the next 3, 4, 5 years, that you're probably going to see more exposure to Chinese companies?
Yeah, so actually the FT had an article on that a couple of days ago about it being a marathon, not a sprint. And the fact that at the moment, the US AI trade or tech sector is winning because they have the more sophisticated models, basically because they have NVIDIA chips. And what this goes on to argue is the fact that if you look beyond that, things like inference, and more importantly, the fact that the government in China is completely aligned with the rest of the Chinese companies. So it's been the private sector in the US that's been moving the AI trade, where they've spent the capex. In China, it's the actual government that's spending all the money. It's aligning itself with Moonshot and Alibaba and JD and all these. And they are using all of that technology together. They have, as you say, the most sophisticated grid. They can build data centers much quicker than they can in the US. And because of that reason, one has to kind of think, be it in 3 or 5 years, that they will be potentially more advanced than the US. And alongside that, there's an argument that they will be building their own semiconductors. They don't actually want to rely on NVIDIA. And you can see they haven't had to. They've been able to actually create very sophisticated, lower energy producing, quicker models with smaller clusters with more unsophisticated chips. And that's only going to get better in time. So yeah, I think it is a potential danger. But having said that, one of the saving graces is that the West will not want to use Chinese technology. They're worried about, they're worried about spying. They're worried about the data leakage, et cetera, and you laugh, but it is the saving grace of the West right now.
It's exactly that, and with geopolitics playing out different scene every day, we'll see maybe the Europe and all those leading more towards China for tech going forward. Who knows? The world is changing very quickly. Jared, very insightful indeed. And again, reiterating, diversification remains key in very uncertain times. All is not rosy. There's a couple of risks that we really need to look out for and consider as well. Thank you for your time and spending time with us this morning. And we'll chat to you in the near future again. Thank you so much.
Great. Thank you.
To our audience, thank you so much for being very patient with us in keeping with time. But I think some of the comments and the content that came through was massively interesting and giving us a lot of thought for how to construct portfolios going into 2026, what to look out for. We've got our second round next week, Wednesday, with more top global fund managers. Looking forward to seeing you next week, Wednesday. And to all our presenters, thank you so much for great content today. Again, as usual, we in deep appreciation for your time. Looking forward to seeing you all next week, Wednesday. Thank you so much.